Welcome to the SOFI Machine Learning virtual conference. This event is hosted by the Keene Institute at the University of North Carolina at Chapel Hill. I'm Eric Geisels. I'm the faculty research director of the Rethink Labs at the Keene Institute. The Keene Institute is an institutional member of SOFI. SOFI is the Society for Financial Econometrics. Brian Kelly from Yale University, Dasheng Xiu from the University of Chicago, and myself put this program together. The conference was also co-sponsored by the Journal of Financial Econometrics, which is the journal of the Society for Financial Econometrics, as well as the International Center for Finance at Yale University. Before we start, I'd like to thank a few people who made this event, the organization of this event, possible. First and foremost, I'd like to thank Chelsea Donoghue, who is the Assistant Director of the Rethink Labs at the Keene Institute. I'm really grateful to her and indebted to her for making this event possible. I'm also grateful to Victor Quadros, who is our IT person, who will be helping us today with the Zoom sessions. A little bit of housekeeping. I will be chairing the first session, and Brian will be chairing the second one, and Dasheng will be chairing the third and last one. Each session has 2 papers. The presenters will have 25 minutes for presentation, and then the discussants will have 15 minutes. At the end, there is 5 minutes left for Q&A. Please write your questions in the Zoom chat. We have a lot of participants, so I'm afraid that we will probably not be able to field all the questions that will be entered into the chat. Finally, we are really delighted for so many participants to participate in this event today, and it's going to be a great day. With a lot of interesting papers. That being said, I'd like to start the first session. Mirela, I think is it Mirela or Paul is going to present the paper? I'm not sure.
I'm going to present it.
Mirela, good. And Rohit, Alina will be the discussant. If would be so kind to share your screen, Mirela, so that we can see your slides. Welcome.
Okay, so can you see my slides?
We can.
Perfect. So first of all, I would like to thank the organizers for accepting our paper to the program. I'm very excited to be presenting it today. So this is joint work with Paul Schneider, who's at the Swiss Finance Institute in Lugano. So in this paper, what we are going to do is that we are going to develop a residual mispricing index from asset prices alone. And we are going to show you that it's related to financial uncertainty, and it's also related to conditional risk premia. So to give you a brief outline of the talk today, I will start by motivating the approach, give you the theoretical framework, and then go to the empirical analysis and wrap up with the conclusion. So for the motivation, builds upon the following Euler equation pricing restriction. So in asset pricing, we know that if we want to price different asset returns, so R is going to be a vector of asset returns. We have a stochastic discount factor M, and we know that in expectation, if R is a gross return, this has to be equal to 1. Of course, if instead we have here an X as return, then here we will have a 0 vector. So what is the goal? We want to explain the cross-section of asset returns. And in particular for us, we are going to focus on international asset returns using simply a function of some factors. So we want to specify this stochastic discount factor as being function of some factors. And importantly, we want to ensure that this stochastic discount factor is a proper object. So it's going to be positive in every state of the world. So we focus on international markets because this is like a natural laboratory, because we will have usually just a small set of factors that are going to price international asset returns. So to give you an example, if you think about the cap M, we know that we can express M in the following way. So we are going to have 1 minus betas times the market X's return. Okay, so I'm going to go again through all these 3 different building blocks, and I'm going to show you how we contribute to them. So most of the literature so far has focused on an unconditional version of this Euler equation pricing restriction. What we are going to do is that we are going to focus on the conditional version of it. And more importantly, we are going to derive a stochastic discount factor that it's ensured to be positive. So why is this important? Well, we know that unless we have some restriction in the example of cap M, M can be negative. So whenever M becomes negative, it means that we will have some arbitrage opportunities. So what we do in this paper is we are going to provide you the smallest modification to linear asset pricing model that is going to be compatible with no arbitrage. And we are going to have an economically motivated correction. So the SDF is going to be comprised of the linear model. So here you can have some factors entering the SDF. And here we are going to have the nonlinear part. So why is this additive form important? Well, because we are going to specify this nonlinear part such that it's orthogonal to the linear model. So it means that by construction it's not going to impact the prices, so it will have no price impact. But I'm going to show you later on that it's going to command a premium. So of course, you can think about having an exponential form for the SDF, for instance. But if you specify an exponential function for the SDF, of course, you will have positivity, but you will lose this nice additive property. And this nonlinear part, we are going to construct it in a way, we also call it the residual mispricing. We are going to construct it in a way that is going to have the minimum volatility. Okay, so this is what we are going to call residual mispricing. So it's going to be the part that you have to add to a linear model such that you ensure that this stochastic discount factor is going to be positive in every state of the world. So intuitively, we are going to have a polynomial function of even degree for this stochastic discount factor. And economically, you can interpret it as the lowest cost of a Sharpe ratio maximizer agent. So we are going to contribute to several strands of literature. This is by no means an extensive literature review, but we know, for instance, from the low risk anomalies literature that the pricing residuals from the asset pricing models, which are linear, are going to have a pronounced factor structure. So we know in particular that idiosyncratic volatility, but also that skewness and co-skewness is going to have an impact, meaning that higher order moments are going to be important for determining the risk premia of different asset prices. We are going to contribute also to the unspanned risk literature because by construction, our residual mispricing index is going to be an unspanned risk, meaning that it's going to have no price impact on the assets, but it's going to command a premium. And in our theoretical framework, we are going to focus on minimum dispersion stochastic discount factors. And since we work with conditional expectations, we are going to use a machine learning approach, which is called the reproducing kernel Hilbert spaces. So I'm going to show you why this is a very powerful approach. So of course, both Brian and Yucheng have done extensive work in this, but to the best of our knowledge, the only other paper that also employs the RKHS or the kernel trick is to this date COSAC. So we are going to estimate conditional expectation and document that the residual mispricing risk is going to be priced. So what we do in this paper is the following. We are going to let the data choose what is the optimal stochastic discount factor. And we are going to do this using only asset prices. And the only condition that we impose is going to be the no arbitrage. We are going to extract the residual mispricing index, and we are going to estimate the conditional expectations of asset returns. And then we are going to ask what are the time series properties of this residual mispricing index, and in particular, whether it is related to risk premia and to uncertainty. Okay, so let me go to the theoretical framework. We are going to have a very general financial market structure in which markets are incomplete and arbitrage-free. I'm going to denote by R the vector of excess returns, and R0 is going to denote the risk-free rate. And since we know that in incomplete markets, we may have a possible infinite number of different stochastic discount factors, we are going to focus on the minimum variance SDF. So why? Because this is going to be linear in the returns that we are going to price, and it's also going to have an economical interpretation in the sense that it's going to give us the bound on the maximal attainable Sharpe ratio in these economies. So this is how the objective function looks like. So we are going to minimize the second conditional moment of the stochastic discount factor, such that we correctly price the excess returns. And we are going to fix the mean of the stochastic discount factor as the inverse of the risk-free rate. And very importantly, we are going to make sure that at every point in time, the stochastic discount factor is going to be positive. So after we estimate the solution, we are going to decompose it into a linear part. So you can think of this as the original solution from Hans and Gaetan, just that it's conditional. And then we are going to have a nonlinear part that ensures positivity. And this is what we call the residual mispricing. Okay, so in order to solve this problem, of course, we need to estimate expected returns. So how to do this in practice? So what people have done so far was to express the returns as a function of the conditional returns plus some errors. And of course, you have to specify here some predictors to minimize this error. So we have this additive predictive form. And usually people run linear regressions while specifying some predictors in order to minimize this error. So we want to be more general than this. We want to be model free in the sense that we don't want to impose any functional form here. So what we are going to do, we are going to learn the conditional expectation function using the reproducing kernel Hilbert spaces. So you can think of this RKHS as a generalization of linear regressions. And instead of doing it for a particular function, you can do it for any function that is a member in this RKHS space. So this is the so-called the kernel trick. So instead of having here the identity function or a linear model, we are going to do it for any possible function in RKHS. So why is this very powerful? Because we are going to transform a possible infinite dimensional features problem into a linear, into something that can be mapped using a linear algebraic model. So this is the so-called kernel trick. Okay. So now, going to the empirical analysis, we are going to have monthly returns from January 1975 until June 2020. We are going to have local and foreign short-term bonds, the 1-month deposit rates, and also aggregate equity, which are simply the MSCI country indices. We are going to take as the domestic market the US market and the following foreign currencies. So in all of our estimations, we are going to have bilateral exchange rates. And for the conditioning variables, we are going to focus on the interest rate differential and the realized volatility of the exchange rates. So following the extant literature, these are the two most widely used conditioning variables in international markets. So let me show you how our extracted residual mispricing indices look like. So in the top panel, I'm plotting the US residual mispricing index, and in the bottom panel, I'm pricing the international one. So the international one is simply going to be the average of all the foreign residual mispricing indices, excluding the US. So what we see is that it spikes during bad times, so during periods of financial distress, such as the Black Monday, also during the Asian crisis and the LTCM, of course, during the financial crisis, and importantly, we see that recently we have experienced levels of this residual mispricing that are almost as high as the ones that we had during the financial crisis. So the residual mispricing is going to be countercyclical and is going to spike in bad times. And we see that the two time series, either if you take the US one or the international one, are going to be highly correlated. Okay, so here I'm plotting the conditional risk premia. So you see how it can vary through time. It's by no means constant. So for illustrative purposes, I'm only plotting it in the top panel, the domestic US one, and in the bottom panel, the foreign Swiss one. And what we find, and it's very interestingly, we find that the conditional currency risk premia can be approximated by taking the difference between the foreign and domestic equity conditional risk premia. So of course, we are going to have time varying weights. You see that the conditional currency premia is going to have significant spikes during the crisis. And more importantly, for the US and Swiss example, in the 2015, there was an episode in which the Swiss National Bank released the unpeg of the Swiss franc with respect to the euro. So we see that by estimating using the conditional risk premia, we are able to capture this spike. Of course, focusing instead on unconditional risk premia, you would not be able to capture such events. Okay, so then we are going to ask whether there is a mispricing premium in equity and currency returns. So for this, we are going to apply the usual Fama-Macbeth approach. The novelty would be that instead of having here the realized returns, we are going to have the conditional expected returns. So this approach is going to proceed in two steps. First, we are going to run time series regressions from the conditional expected returns on our measure of mispricing to estimate a time series of the beta coefficients. And then in the second step, we are going to run cross-sectional regression on the estimated betas in order to estimate the price of risk associated with mispricing. So what we find when we consider different types of test assets. So first is the equity. The second column, I'm reporting the international equity. The third column is the currency. And the fourth one is combining domestic and international equity. So what we see is that the price of risk, which is associated with our residual mispricing index, is positive and highly significant. And to have a better representation, we see that the residual mispricing index explains the cross-section of returns because all of these returns, they line nicely and close to the 45-degree line. Okay, then we are going to ask whether we can relate the residual mispricing to different financial indicators. And given that it spikes during periods of financial distress, it's only natural to compare it with a measure of financial uncertainties. So here I'm plotting on the left axis our US residual mispricing and on the right axis the VIX. And we see that they co-move, having a correlation of 50%. And if we were to do also regression analysis, we find that our measure of residual mispricing explains 25% out of the time series variation in the VIX. We also link it to another measure of financial uncertainty, which is by Jurado, Ludwigson, and Eng. So this is the financial uncertainty index. It's comprised of 150 different indicators, having both economic indicators and financial indicators. And we see again that there is a strong positive co-movement. So to test this relationship more formally in the data, we are going to run the following time series regression. So we are going to regress the uncertainty on our extracted residual mispricing index in the different markets. So the first one is the US. Then we have all the other foreign markets, and international, remember, is going to be the average of all the foreign markets, excluding the US. So what we find is that the residual mispricing index is going to be able to explain up to 20% of the time series variation of financial uncertainty. And most importantly, this relationship that we document holds also out of sample. So to test it out of sample, we are going to proceed in the following way. So we are going to train our machine learning model from January 1975 to December 84 with monthly sequential increments. So this is good because it's going to be free of look-ahead bias. We are going to start the out-of-sample period from January 1985, and then we are going to roll it with monthly sequential increments until the end. So we see that even in this case, we are going to have a high R-square of 5%. So it means that the link that we document between financial uncertainty and residual mispricing holds also out of sample. Okay, and then we ask what are the possible origins of mispricing? So what's happening? Are investors not able or unwilling to trade? And to answer this question, we are going to explore the link with financial intermediaries. Why? Because they are going to be sophisticated agents, and they are going to be positioned in the unique way in which they could offer these nonlinear payoffs to investors in order to hedge against periods of high uncertainty. So it's also very likely that the periods when the risk-bearing capacity of these financial intermediaries is impaired will coincide with periods of high degree of mispricing. So as we saw during the financial crisis, or more recently also during the COVID era. So to this end, we are going to rely on the proxies of Haeckel and Mirela. So we are going to have the capital ratio, which is going to be the ratio between the aggregate market equity divided by market equity plus aggregate debt of primary dealers. The capital risk factor, which is simply going to be a shock to the capital ratio. And lastly, we are going to examine the link with the leverage ratio squared. So this is simply the reciprocal of the capital ratio squared. So we see that for both capital ratio and the capital risk factor, the expected sign is negative, but the relationship is not statistically significant. Whereas for the leverage ratio squared, we find positive and significant relationship. So this is in line with the predictions from dynamic asset pricing models featuring intermediaries, meaning that you should expect to have a nonlinear relationship between the asset risk premia and measures of financial distress. So following this evidence, we are going to interpret our residual mispricing as a measure of financial distress. Of course, we find that even if we want to relate it to measures of funding liquidity constraints, so such as the debt spread, we do find that during periods of low funding liquidity, so when the debt spread is going to widen, this will coincide with periods when our extracted residual mispricing is going to be high. And lastly, we are going to ask whether we can relate it to existing measures that capture different arbitrage violations. So Paolo has a paper in which he provides a market dislocation index. This is simply going to capture different arbitrage violations in international markets. So it's going to measure instances when we have violations of the covered interest rate parity, also of the triangle arbitrage, meaning that if you want to compute the exchange rate between the Swiss franc and the euro, and you have also the US dollars, you should have that the triangular arbitrage holds, but we know that in reality, it may be violated. And the last arbitrage violation that it's included in this index, it's about the ADR. So whenever a US company is going to list its shares on a foreign market. So what we see is that we do find a positive correlation between the two, but there's going to be a conceptual difference between the two indices in the sense that the market dislocation index is going to be based on realized arbitrage opportunities, whereas our residual mispricing index is constructed such that there is no arbitrage. And more importantly, comparing our index with respect to all existing indices is that it requires far less data. So if you have only the bond and market return alone, you can extract this residual mispricing index. So you don't need complicated models, and also you don't need any options data. Okay, so to wrap up, what we have done in this paper was to develop a measure of residual mispricing from asset returns alone. This is going to be consistent with arbitrage-free linear models. It's fast to compute and fully conditional. We have provided an illustration of the time series properties of international residual mispricing indices and their risk premia implication. And we found a strong link between our index of residual mispricing and financial uncertainty, but also with funding liquidity constraints. So thank you for your attention. I look forward to the discussion and your questions.
Rohit, go ahead. I think you can share your screen now.
Yes. Is my screen visible to all of you?
Yes, it is.
Okay, thank you. First, I thank the organizers for inviting me to discuss this interesting paper. I'll briefly discuss the main contributions of the paper, and then I'll ask some questions that I got while reading the paper, as well as suggest some solutions to these questions. To put it in the context, explaining asset pricing using stochastic discount factor is a fundamental problem in finance, where stochastic discount factor is a discount rate which prices all assets such that this equation holds. Literature proposes various stochastic discount factors. For example, in a simple CAPM word, the stochastic discount factor can be written as a linear combination of market returns. However, there is ample evidence that shows that linear model stochastic discount factors do not explain asset returns well. For example, there is a paper by Huang and his co-authors where they document that idiosyncratic volatility, which is residual related to a linear factor-based model, explains asset returns well. So one of the limitations of these studies is that these pricing residuals change with the benchmark linear model that we use. For example, if we use CAPM model, then we get one set of residuals. If we use a Pharma-French model, we get a different set of residuals. This paper tackles this question by coming up with a generalized model that models the pricing residuals in general. For example, in particular, they build on Hansen and Jagannathan framework, and they note that linear model stochastic discount factors violate the standard no arbitrage restriction, by which I mean that linear model SDFs are not positive in every state of the world. And this paper shows that if we add a non-linear component to the linear component, then we can make the stochastic discount factor in such a way that the no arbitrage condition holds. For example, first of all, this paper starts with an incomplete market assumption. And as a result, there could be many stochastic discount factors which prices as asset returns well. And as a result, this paper chooses minimum variance stochastic discount factors. As in, given a set of many stochastic discount factors, this paper chooses a minimum variance discount factor such that the variance of stochastic discount factor is minimized, and the stochastic discount factor prices given set of test assets. And this stochastic discount factor satisfies no arbitrage condition, by which I mean the stochastic discount factor is greater than 0 in all states. And now to solve for this equation, this paper restricts themselves to a special space of stochastic discount factors. As in, this paper argues that every candidate stochastic discount factor can be written as a linear combination of returns plus a non-linear combination of returns, where the non-linear combination of returns could be expressed only in terms of polynomials in terms of returns. And by doing this, this paper theoretically argues that even though this linear SDF violates the no arbitrage condition, if we add the non-linear component, then we could make sure that the total SDF satisfies no arbitrage condition. And another theoretical result this paper shows is that this non-linear component is orthogonal to the linear component. And as a result, this paper argues that if you look at the non-linear component, then this non-linear component can be interpreted as residual mispricing, as in mispricing where the linear mispricing related to the linear asset pricing mode. So this is the first theoretical contribution of the paper. And now the main task is to estimate this stochastic discount factor or to estimate this coefficients or the weights C's. To estimate this coefficients, one needs to estimate the conditional moments of returns and conditional moments of return polynomials. So to answer this question, this paper uses a machine learning technique known as kernel trick. So basically what this trick intuitively does is, without using any model specification for returns, one could directly estimate the conditional moments of returns as well as conditional moments of return polynomials. So here is the intuition. For example, suppose the goal is to estimate some conditional moment of returns given some information Z star. And now how do we intuitively do this? Well, to estimate this, just go back to the past data and identify all those periods where the state variables are close to the Z star state variable and just take the sample mean of that. So that would be a good estimate of this conditional moment. And this is called the kernel trick. To be more specific, the kernel trick is a weighted average of all conditional moments where the weights are proportional to the kernels. As in, for example, if you want to estimate this conditional moment given Z star, then go back to all past data, identify those periods where the state variables are close to this, get the moments, put more weights on it, and put less weights on those time periods where the state variable is far away from the state variable, Z star. And the kernel represents the similarity between any two state variables. So this is one of the main contributions of the paper. That is, to estimate the stochastic discount factors, one should get hold of the conditional moments. And this paper uses machine learning technique known as kernel trick to estimate these conditional moments. And this is the second contribution of the paper. And the final contribution of the paper is to apply this methodology on international economies. And this paper examines aggregate equity and short-term bonds. And what they do is, on this international data, they extract stochastic discount factor, as in the linear component of stochastic discount factor, as well as the residual component, which is the non-linear component of it. And the key findings of this paper is that the residual component, that is the non-linear component, seems to be related to the financial uncertainty. As in, if the financial uncertainty is high, then the residual mispricing is high, which in a way says that linear models are more likely to fail when financial uncertainty is high. And they also show that this residual mispricing is positively priced in the cross section, and this relates to various uncertainty and liquidity measures. So overall, these three are the main contributions of the paper. However, I have several questions while reading the paper. First, to estimate conditional expected returns, the paper uses information only from two variables, which is interest rate differentials and realized volatility. And my question is, how robust are your findings if you increase the conditional information set? And this question would be important because of the recent paper by Perlger, Chen, and Zhu, where again they use sophisticated machine learning models to extract linear stochastic discount factor, but in the context of US individual stocks. So in contrast to this paper, they restrict themselves only to linear asset pricing model, linear stochastic discount factors, but they do impose no arbitrage condition. However, the weights of the stochastic discount factor is estimated using a big conditional set. And one of the empirical findings that they find is that the residual mispricing from this linear stochastic discount factor is small during the times of crisis, which contrasts this paper. For example, during the times of crisis, the mispricing related to this linear asset pricing, this linear stochastic discount factor, is actually low. So my question is, if you increase this conditioning set, maybe your linear SDF would capture different information, and as a result, the non-linear SDF may not really exhibit the key features that you document in this paper. And the second point is, we all know that idiosyncratic volatility is negatively priced. However, this paper shows that RMP is positively priced. Note that idiosyncratic volatility itself is a mispricing index. So I just wonder whether these two are related, and if yes, how do you reconcile these opposite findings? Again, my point is, what if you increase this set? And again, another related question is, how do you decide on what information set to use? And the second question is, to define the residual mispricing, the paper defines residual mispricing based on this linear model, which is the non-positive linear SDF used by Hansen and Jagannathan. But my question is, how standard is this benchmark linear model? For example, the paper calls this linear model, linear SDF, as linear market SDF. But shouldn't the market SDF contain the market factor? As in, shouldn't the market SDF be expressed as some linear combination of market returns? For example, in your context, the market factor would translate as simply cross-sectional average of all securities. But and as a result, every linear SDF need not be equal to linear market SDF. So I just wonder how standard is this benchmark linear model? And again, people have documented common risk factors in this international economy, and the paper does not discuss much about the linear SDF. So I just wonder how this linear SDF is related to the common risk factors documented in the international equity returns. And finally, this residual mispricing, note that uses information from the current return data. For example, if I have to compute residual mispricing at T+1, then I'll have to use information at T+1. So in a way, this residual mispricing is an ex post measure. So my question is, would it be possible for you to ex ante identify when linear models would fail and when linear models wouldn't fail? This question could be important because one could form trading strategies. For example, betting against beta as well as idiosyncratic volatility, which are two different mispricing indices, are ex ante measures. So overall, I find that the paper is very interesting. Personally, I have learned a lot reading the paper, and I look forward to reading an updated version of the paper.
Thank you, Rohit. We have plenty of time for either Mirela or Paul to answer some of the questions.
Sure. So first of all, thank you, Rohit, so much for this excellent discussion. So I will try to answer or address some of your questions. What it's nice or maybe limiting, depending on how you interpret it in international markets, is that there are not so many conditioning variables that actually are able to predict exchange rates. So since you already start with a small set of conditioning variables, actually having only the realized volatility of the exchange rates and the interest rate differential will do a good job. Then, of course, depending on what your conditioning variables are going to be that you actually insert into the model, your conditional expectations are going to be very related to that. So if you want, all the variability in our conditioning expectations are going to be given by the conditioning variables. So it's true, but in the sense that these two variables have been shown to be the most representative in international markets, this is why we focus on them. And then, of course, since we do it in multiple economies, we also wanted to have some conditioning variables that are available for all of these economies. So we developed this residual mispricing not only for the US, but also for the set of the developed economies. Okay, related to another question that you had. So what we have done, it's true that if you want to price more assets, in particular the ones that have nonlinear payoffs, so think about options, you are actually going to decrease the residual mispricing. So in this setting, at least not necessarily accounting for more conditioning variables, but rather trying to price assets that have nonlinear payoffs are going to decrease the residual mispricing. Okay, so whenever you project on the set of returns to derive the stochastic discount factor, the stochastic discount factor is going to already embed the risk factors that you have driving the prices of these assets. So it's true if we look, for instance, at the minimum variance SDF, exposed, we do see that it's related or that it correlates with the market factor, also with momentum, and also with the intermediary risk factor. But what's interesting is that we have checked and the residual mispricing does not correlate with these factors. And also it does not correlate with other factors that people usually use in international markets. So for instance, with global factors such as the carry and the dollar, they seem to be unrelated to our residual mispricing index. So our interpretation is that since exchange rates usually crash from time to time, the residual mispricing is important, especially during those periods. Okay, and for the so we have also derived results in the paper in which we look exclusively at out of sample. So then we only take into account all the observations prior to the date, and then we make a prediction. So we don't necessarily compute in our conditional expectation, also accounting the RT+1. So we take everything which is prior to that date, and then we do the estimation 1 point ahead. So thank you again for this great discussion.
Thank you. Paul, you don't have anything to add to this?
No, thanks, Eric. I'm good. I'm very happy with Mirela's answers. Thanks.
Well, I don't see questions in the chat, so let me ask perhaps a question. I mean, what precludes you from looking at you said that you're constrained in the international context of conditioning variables, but what precludes you from just taking US conditioning variables as a proxy? I mean, that seems to me like reasonably fair to start with.
So definitely, we can do that. But then there is the question, like, how relevant would this conditioning variable from the US be important also for the Swiss economy or for the Euro area in different times? I agree, but this is definitely something that we can try. So we will try and do it.
Thanks. Anybody else wants to shoot a question? I see one. Well, what machine learning program was used to extract, I guess this is the kernel one,
yes,
right?
Yes, exactly. So everything, it's a convex optimization program, and we used R and Mosaic to derive all the results.
Thank you. If there are no other questions, I think we will take a brief break before we go to the next session, which will start at 11 with a paper, and I think it's going to be Olivier Scaillet who will be presenting it. So see you shortly. Thanks again.
Thank you,
Mirela, Paul, and Rohit. This is a very nice paper. Thank you very much. See you soon. Welcome back, everybody. Pleasure to introduce the second paper on the program, and it will be Olivier Scaillet who is going to be presenting it, and Paolo Zaffaroni is going to be the discussant. Go ahead, Olivier.
Okay, so first of all, thank you very much for inviting me to this very interesting conference, and for putting me first, taking into account the the lag between Europe and the US. So it will be indeed a penalized two-pass regression. So Mirela, in fact, already presented that type of regression in the previous talk, and this is related to what is called the Fama-Macbeth type of methodology. So what we will do is we'll use it in order to predict stock returns, and basically we will do that in a time-varying way. So we'll use a time-varying risk premia. So this is a joint work with Gaetan Bakalli, who is a PhD student of us, and Stephane Guerrier, who is also at the University of Geneva. Okay, so this is a motivation, and in fact the motivation is very simple. Okay, so what we really want to do is to have a penalized method, penalization method, so that we can select models compatible with finite theory. So we want to explicitly take into account the no arbitrage, and we don't want to introduce arbitrage ex ante. Okay, you can think that as a structural approach to machine learning or big data. And the second stuff is that we really want to understand so whether we have indeed the need to introduce time variation, so to time varying factor loadings or not. Okay, so this is basically the part of the main result of the paper. We'll see that if you take off-the-shelf method like a lasso method, also, and you don't take into account no arbitrage restriction, you can see that you end up terribly, in the sense that I will end up with 100% of the model which will be not arbitrage free. So they will present arbitrage ex ante. Okay, so if you use a naive and brute force approach, you can see that it hurts a lot. Okay, the second result that we have is this one. As you can see, we will end up with 42% of the stocks where a time invariant model will do a good job. Okay, but for the rest of the 58%, the other, we need really time varying factor loadings. Okay, so what is the idea? The idea is in fact to take as a reference a time invariant model to add some extra instruments or extra variable to introduce some time variation, and to shrink towards the time invariant model, and to see whether we need that extra those extra common instruments or characteristics. So this is basically the idea. Okay, so this is a two-pass penalized methodology, or the Fama-Macbeth regression. So Mirela showed the usual form, which tells you that if I look at the expected return, it will be the factor loadings multiplied by the risk premia. Okay, and you start from a standard factor model. We are working with the arbitrage pricing theory. Okay, so what we will do is in fact to use another form, okay, which is the one that we introduced in paper with Patrick and Elisa, where you can explicitly see that you should be very, very careful when you do the modeling. It's because you have an explicit relationship between the factor loadings and the intercept. And if this is not the case, if you don't take into account that restriction, you will end up with a model with arbitrage. Okay, so you should really be careful when you write your model. So what we will do here in the two-pass penalized methodology, okay, we'll have two penalizations. The first one is in the first pass. So what we'll do is we'll introduce what is called a group lasso with overlap to select the drivers of the factor loadings and to ensure that we have no arbitrage restriction. Then we will do a time series regression to estimate the BIT. So we do a post OGL if you want. And then in the second pass regression, which is a cross-sectional one, the first one is a time series one, the cross-sectional one in order to estimate the new, and we will also be able to estimate the drivers of the conditional mean of the factor, so that we can deduce indeed the risk premia. Okay, so this is the idea. Okay, so this is the outline. I will basically jump immediately to the modeling. So we use the setting of GOS, also Gagliardini, Sola, and Scaillet in 2016. For people who are interested, so you can also read, we have a chapter in the Handbook of Econometrics, which was published in last December, where in fact we summarize that literature about a large dimensional factor model, etc. So probably that chapter is easier to read than the Econometrica paper, but I strongly urge you to have a look at that if you want to have more background on that. Okay, so we have a standard factor model where you have a time-varying intercept, a time-varying factor loadings, and a bunch of factor, and we have the usual condition of a regression. Okay, so this is the asset pricing restriction that I have already mentioned, and that we will really want to introduce explicitly in the modeling and to take them into account. What is the conditioning information? Also, we will distinguish between what are called common instruments. As you can see, there is no I here. So those will be common to all stocks, and you will find the usual suspect like microeconomic variables or dividend yield or term spread or default spread, etc. And then we also introduce stock-specific instruments or characteristics. And again, you will find the usual suspect like the size, book to market of the firm, etc. Okay, so we'll have those two types of instruments which will drive the dynamics of the model. Okay, so this is really the novelty in the specification. Okay, so what we do is we take exactly the same type of setting as in GOS and other paper. So we'll model the factor loadings as a linear function of common instruments and characteristics. Okay, now as you can see, there is a difference with respect to GOS, is that the BI and the CI are assumed to be sparse. Okay, so as I told you, what is the idea is to start from a time invariant model to add extra goodies which will correspond to the common instruments and the characteristic, to put a lot of them, okay, and then see also which one will be shrunk to zero or not. Okay, so this is for the BIT. We do exactly the same for the modeling of the risk premia and for the conditional factor. You can see that you have a time invariant contribution, and then we have a time varying contribution that we assume to be sparse. Okay, now this is the main difference with respect to the first GOS paper, also where we were not assuming that we have a sparse matrix. Okay, so now the time invariant contribution, so in fact are taken as full. Okay, so we really take a full vector specification. So the time invariant specification will not be sparse, but it's only the drivers of the dynamics that we assume to be sparse. Okay, so this is really the novelty in the specification. So this is the data generating process that you get when you take into account the no arbitrage restriction. And as you can see, this will be the AIT, so the intercept contribution, and this will be in fact corresponding to the factor loadings. Okay, and as you can see, also you have indeed, if I have a ZT in my BIT, you see that the ZT will also pop in because of the no arbitrage restriction in the intercept. Okay, so you should be careful and this is the main message of the paper, if I decide to kill this guy, okay, I should be very careful, because in that case, my no arbitrage restriction is no more valid. Okay, this is really the idea. You cannot just take part of the specification without thinking a little bit, because you can introduce also no arbitrage ex ante. So this is the key idea of the paper. How do you select the ZT and ZIT in order to maintain the no arbitrage restriction? Okay, so this will be the type of constraint that we introduce. Okay, for example, if the selection procedure selects at least one variable in ZT, then it should also select at least one element in ZT minus one, or vice versa. If I delete ZT minus one in the intercept, I should also delete ZT minus one in the factor loadings. And this is a type of mechanism that we want to introduce, but of course in an automatic way. Okay, and this is the idea. Okay, so we use a generic panel model where we use these XIT and X2T. XIT will be what is important to model the intercept, and the X2T what is important for the factor loadings. Okay, and we get a general regression model. And this is what will be estimated. So what do? We use a group lasso with overlap also to estimate the drivers. Then we have a post-OGL approach using a time series, and we have in the second pass regression the standard cross-sectional regression. Okay. Now, why also the OGL penalization? This is an example that we develop in the paper in order to try to have a bit the intuition. Okay, so we take a very simple example with two factors, one common instruments and one characteristics. So this will be the drivers in AIT, and this will be the drivers in the factor loadings BIT. Okay, so what we try, and so if you look at the different combination that you get, we have a very nice table in the paper where we show what are the 36 possible models. So when you combine all these regressors in order that you don't have arbitrage ex ante. Okay, so all the other one will introduce arbitrage by definition ex ante. Okay, so what you have to do is in fact to build groups. Okay, and this will be in fact you will get 6 groups. So indeed, if you kill one of these groups, there is no problem. Okay, and if you decide to erase some of the variable, you should group them in order to maintain the no arbitrage. Okay, so this is the idea that we have in the paper. Okay, I'm already a little bit late. So the other benefit that we have, and we have, I would say, a nice result, is that if you compare to a lasso approach where you don't include the restriction, so you just penalize individually each covariate, so you see that in fact you have an upper bound. Okay, so if I consider the group lasso with respect to the standard lasso, I will have an upper bound, which means that I will reduce at least by 8 the number of models which are explored. The total number of models which are explored by the algorithm. Now, in our empirics, so we have a 5-factor, 6 instruments, and 13 characteristics. So you see that we have a lot of regressors of covariates, 219. You can see that the dimension reduction is huge. Okay, so in fact, with respect to the standard lasso, you reduce the number of investigated models by 2 power 116. Okay, so you drastically diminish the number of models explored also by simply introducing also information coming from finance theory. So this is really the benefit of relying on finance theory. Okay, I will skip the whole detail about the technicalities. We have also a proposition which shows that we have consistency of our estimate when we have indeed, also you see that you have S-hat, so where we estimate the support of the regressor, and we have also a similar consistency results for the risk premium. Okay, also we have some results about consistency. Now, simulation study, yeah, I have only 10 minutes. So believe me, they work, okay? So so I will not spend too much time on that. As I usually say, if there are Monte Carlo in the paper, it means that it works. Otherwise, I will not show them.
Olivier, you have a little bit more. You have about 12 minutes. So
12 minutes, okay.
Yeah.
So
don't rush.
So simulation study. This is what we want to corroborate with the simulation is that indeed, if you look at the arbitrage, okay, so this is the percentage of a model that you end up with arbitrage. And you see that if you use a standard lasso and post lasso, you get indeed a very bad message. Okay, you end up with close to 100% of the model presenting an arbitrage. So they do not respect the no arbitrage restriction. Okay. The second result that we have is that this is a support. Okay, so in the what we have is that if you have a nice selection model, the probability that the true support SI contain also belongs to the estimated support, that probability should go to 1. Okay, and what do we get? This is exactly what we get indeed for the OGL and the post OGL. Okay, in the lasso, again, pretty bad. You end up with 0 model where you are, which include the true, where the true support is included in the estimated support. Okay, so again, a key advantage of introducing the no arbitrage restriction explicitly. Look also at the number of true. So here, the oracle correspond to the 24 regressor that we have, and you can see that in average we are close to it, while on the contrary, the lasso so only include 11 of them. Okay, so this is the danger of using a simple methodology. What we also show is that the prediction error distribution are more centered to 0 for the post OGL than the post lasso. Okay, so again, a better job in terms of prediction error. Okay, so there I would like to spend a little bit more time, okay, to show you, so what do we get in a prediction exercise, okay? So it is a machine learning or big data conference, okay? So as you can see, we have a fairly large data set, so we have close to 7,000 individual stocks coming from CRISP, okay? So we really work with individual stock. We consider the 4-factor model of Carhart with the market, the book to market, the size, and the momentum, and the 5-factor model of Fama French. Okay, so we have 6 common instruments. Okay, so this will be the usual suspect. You recognize the dividend yield, the default spread, and the term spread. And we borrow from the paper by Freiberger et al. We look also at a very large number of characteristics, where we look at 13 stock-specific characteristics, okay? And you have, for example, of course, the size, the total volume, etc. Okay, so you see that we have really a large number of common instruments and stock-specific characteristics. What do we get? So I showed you already so that table. So you can see that the post lasso is pretty bad in terms of arbitrage. So you end up with 100% of stocks where the estimated model presents an arbitrage ex ante. Okay, so they don't respect the no arbitrage restriction. So if you use our methodology by construction, you end up with 0. And of course, the time invariant doesn't present arbitrage ex ante again by construction. And as I told you, you really need so some actions, some drivers for 58% of the stock. Okay, more than half of the asset needs time variation in their factor loadings. Okay, so this is one of the first results that we have. Now the prediction error. Okay, so this is in sample. Now you can see that we have a gain in terms of the average absolute prediction error. You see that we have a reduction between 10% and 20% when you switch from the post lasso to our methodology, which is the post OGL. Okay, so it means that also it does a better job in predicting, but in sample. So we can see that as a fit. Now, if you compare to the both methods, okay, so what do we compare here? We compare the predicted return, where we use the relationship between the expected return and the factor loadings estimated, multiplied by the risk premia. This is what we use in order to predict return. And what we do, we compare to the realized return, and this realized return corresponds to an average over the next 12 months. And you can see that both methods do a pretty good job. Okay, so they reconcile pretty well with the realized return. Okay, so what we see with respect to the post-Lasso is that sometimes you have really large negative excess return. And indeed, for example, look at here. So you have also a lot of predicted large negative return, which is a bit strange because you expect a positive reward, positive expected reward from taking risk. Okay, so again, I'm not taking into account the no arbitrage restriction can hurt. Now, the one that I prefer is this one. Okay, so what we do is we try to decompose the expected return as AIT, which is the intercept, multiplied by the factor loadings and the conditional mean of the factor. Okay? So if you believe that the factors are tradable, okay, and they should be because they are long-short portfolio, in fact, the AIT should be equal to 0 because they are tradable factors. Okay? And what do you see? You see that indeed, if we use our method, which does take into account the no arbitrage restriction, you can see that the path, this is the orange area, so this will be the estimated AIT, is close to 0. On the contrary, if you use a post-Lasso, so you don't take into account that no arbitrage restriction, so it means that you can end up with some in the AIT, some ZT and ZIT minus 1, which should not be there. You can see that indeed, so it's much more different from 0. Okay, so by not taking into account the no arbitrage restriction, you introduce fictitiously some dynamics in the EIT that should not be there. Okay, and so this is what we observe in the result. You can also see that the AIT are also sometimes negative and sometimes very large when you are, for example, in that recession time. Okay, so you can explicitly see a lot of differences between the two. Now, out of sample results, okay, so what we do is a standard, and Mirela did that as well in the first talk. Okay, so we have a training sample and we have a testing sample. Okay, so that we have two testing samples between 2000 and 2009. And between 2010 and 2019, and we estimate without seeing those data on the previous period. Okay, and what do we see is where we do a little bit better than the Lasso, but especially so in the recent period, and you can see that the root mean square pricing error is low. Okay, so we do a little bit better. So now what I like a lot is to look at the distribution. Okay, and look at here. So you can see that the size of the box plots are relatively similar between both methods, but you can see that the prediction error, in fact, are not centered on 0 for the post-Lasso, while our is centered on 0. So it seems that there is a bias introduced by not including the no arbitrage restriction. Now, what I like, of course, is this one, so the older period. Now you can see that again, so the prediction error are closer to 0 for the post-OGL. And here you can see that the box plot is much narrower in terms of prediction error. So we do a much better work than the post-Lasso, and also with respect to the time invariant model. Okay, so it seems that it does help to take into account these no arbitrage restrictions. Okay. We have also some auto-sample results, again, the same type of graphs. So you can see that the orange, so the AIT, so this will be the estimated AIT, is relatively close to zero, as it should be if you believe that the factors are tradable. Here it's seen that you have more evidence of deviation from arbitrage. And look at what happens if you use the post-lasso. There you can see that some of the AIT can be very big. You can see that it can be up to 40%. Okay, so you have massive deviation from zero. And here you can see also sometimes very negative, so minus 20%. Okay. So to summarize, also I have just 1 minute left, almost Swiss. Okay, so what are the take-home messages? Okay, so I hope that I have convinced you with the empirical results that taking explicitly into account the no arbitrage restriction coming from finance, so coming from the arbitrage pricing theory, thus helping predictive modeling of large cross-sectional equity data sets with penalization method. I like to call it a structural approach to big data. Okay, so instead of taking out-of-the-shelf techniques developed in statistics. So what is important is to think a little bit about finance theory and about economic theory. So how can I exploit that information in order to reduce also the number of model explored and also to constrain my estimation. So a structural approach to big data where we incorporate finance theory improves on the prediction performance of the estimated quantities. Okay, so you introduce extra structure coming from finance. Okay, further application, of course. So this will be for future work. So a better predictive performance of excess return should help to better gauge time variation in the risk-reward trade-off. Okay, so to have a better idea about the drivers of your expected return and how you can exploit that in order, for example, to time the market. Okay, it should also help to improve performance of time-varying portfolio allocation. So if you want to do a Markowitz type selection, but a dynamic one instead of a static one, so you could exploit also time variation in your predicted return in order to have a dynamic allocation of your portfolio. And this is the further application which are currently left out of the paper. Thank you very much.
Thank you, Olivier. Paolo, you want to share your screen?
Should be share, stop sharing.
Myself. Yeah, can you see?
You're all set.
Okay. Well, first of all, thank Brian, Eric, and Cheng for having me for this actually very sparkling conference. Anyway, and of course, thank for Olivier and others to send me all the information. Okay, so so let me carry on with this. Okay, so just a bit of a content. So I mean, Olivier actually did an amazing good job in a very short time. So in fact, I feel a bit better that I have so much more time in relative terms. So I might not use all of it. So I hope we can have some coffee afterwards. Anyway, so this is a paper about forecasting, beta pricing model, if you want. So which are like linear models, well, conditional linear models on some observed risk factors. So these are the first equation that is in the paper. One feature that you can see, that's why it's written in this way, is really building on the Goss or Gosh, the other paper, the econometric paper that Olivier was referring to, which is essentially a setup where you have is a discrete time continuous asset setup, and this actually is important for a number of reasons. So the factors could be unobserved, but could be virtually anything. So traded, non-traded, and so in general. There is premia are the lambdas, and the lambdas, you can think of the lambda as made by two parts. We have I call it the linear part, which is just essentially the conditional mean of the factors. And then we have the knee, which I call the non-linear part of this premium. Of course, if the factors are traded, knee is just 0, and so lambda is just the conditional mean. So a little bit more on knee plays actually is quite important for a number of reasons. I mean, especially if you think about the statistical properties of the estimates of these parameters. So as I said, it's really sitting on gauche and continued terms of asset. And this is important because is a sort of peculiarity of that setup that when you have no arbitrage, as they show very elegantly in gauche, is essentially like the no arbitrage, which in our at least in my head, if you think about like the usual setup a la Ross, it imposes a bound, right? It's a Sharpe ratio bound. Or if you want, is a bound on the sum of the square place in error, it becomes actually an inequality. So it's drying up, right? The bound, and you have, what you think like what you could call an exact pricing relationship. So these two are like essentially the same notion in this setup. Okay, so that's actually the crucial thing, right? So I call this like star star star. So this is the fundamental equation that is driving all the results. This is a conditional setup, so that's why there is a T in all the parameters, in the A's and the B's, and also the conditional moments of the F. And as you know, it's like there are various ways to model conditioning, right? So if you want like to be very brutal, there are two ways. One is to say that there are like the parameters are some functions, some simple, say, let's say parametric function of some state variables, like that zeta gamma, that's that approach taken here. The other way you could do it, you could just do like non-parametric estimation if you want, say rolling average of the estimate. So that is not what they do, okay? So this is like really well into the tradition, like in asset pricing. In asset pricing, where you use conditioning variables. In fact, Olivier was talking about characteristics, etc. Okay, so you can take any variable. Okay, any anomalies you want, any aspect that you think is going to forecast the data. Okay, so that's the setup. Anyway, so the only big difference to gauche is that in gauche it's like I mean, Olivier was talking about the handbook chapter, but gauche actually is even bigger than that. There is so much stuff there. Okay, but there is no sparsity. Okay, and so this is really the kick here on this paper. And I think sparsity is probably very reasonable for a number of reasons. A, because of course these models are not applied to like sort of single stocks. So you have like a zillion of data. At the same time, as you see from this equation, once you sort of unravel the conditioning, it becomes actually certainly not a simple linear factor model. Okay, so it's quadratic and there are variables everywhere and products of parameters. So it's quite complex. So because of course the aim is forecasting, because I mean you guys tell me that for forecasts like you need a very simple model to work. So you need really the lasso the sort of the special lasso type approach that they use to drive this up. Now lasso of course is also doing this. Right? Lasso is drying up, but it's drying up in a brutal random way. Okay, just statistically, just driving the data and see whether there is some noise that is going to be sort of can be taken away, and so it's drying up some of the parameters, let's say randomly. And that's what not this guy wants, because they want stars to be satisfied. So for example, if lasso was going, say, to kill the B's, then of course it means that you cannot have a non-zero A's, right? So this is a very simple way to do that, right? And so what method that Olivier and coders put up is a way to make sure that everything is compatible. If there is, so there are no zero here unless you want them to, okay? And so as I said, like basically what it does is simply look at the full combination model, is subselecting the one, is searching, is estimating within the number of set that is sort of permitted by no arbitrage. Now it makes me sort of laugh because I mean when you think like this is the simple example, right? 2 factors, 1 factor. Look at this table. Imagine when you have like the real example that these guys put up is quite complex. Okay, and the paper, as Olivier shows, it actually has a very detailed analysis of in-sample, out-of-sample across several metrics with about 6,000 stocks. So it's extremely well executed, and is very solid. Okay, so few comments. So I mean, the paper really is, A is sitting in sort of at the forefront of empirical asset pricing, which is essentially, how can we pin down risk premia? Once we got risk premia, then as Olivier was saying, then of course, we can construct the SDF, we can, construct imbalanced portfolios, et cetera, right? And then of course, plus the other application, corporate finance, cost of capital, et cetera. At the same time, because it's a forecasting, so again, it's sitting also in the sort of, at the center scene of machine learning. Machine learning is about forecasting. It's all about inference. I mean, now they're also working on inference, and I'm sure there will be a lot of stuff going on there, but really is a forecasting laboratory. The paper is extremely solid. As Ghosh is solid, very well written, very well executed. So I strongly recommend to look at it. But is dense. Okay, so if you think that, Olivier was actually warning us, say, oh, if you want to understand this paper, read my other paper. But if you really want to say the other paper, read my chapter. Okay, so so that's an excellent advice. So yeah, read the chapter first. Because I work in this area, I also know Ghosh inside out. And so once you know Ghosh, it really flows, okay? Because it's really sort of slicing out some aspects, some important aspects of Ghosh, and make it work in this setup. But it could be quite challenging, okay? Let's say for the median, reader. So I mean, thank Olivier for the amazing, clear slides. So I mean, as I said, the paper is really done and dusted. So I mean, I'm not going to say do a revolution here. I just put some consideration. The one is about no arbitrage. This is something I keep working on a lot. And this is an example of the thing I was telling before. Like this is the bound that like no arbitrage in a discrete number of assets kicks in. Okay, so there is no equality. And so I guess what this suggests is that then of course if you want to apply that method in a discrete number of asset case, then simply you just replace no arbitrage with exact pricing and you're done. Okay, so this is just a cheap comment, I guess. But more importantly, I think that the idea, I really like this idea that Olivier said about like structural machine learning or structural technique, because I also like the idea that like we can learn a lot from asset pricing, and we combine asset pricing, the constraint for asset pricing to our estimation technique, then actually we have like a win-win scenario. For example, from what work that I'm doing, like estimating, misspecified SDF, etc. You see, if you impose this bound, for example, in a maximum value setup, you get basically an L2 constraint. So you get a shrinkage estimator. Of course, that is different because the shrinkage is shrinking all the parameters right at the same time, if you want, where lasso is sort of stock picking, if you want, right? But you can have variation. You can imagine variation. But my point is that the general message is great, and I think we should really use it more. Like no arbitrage, whatever variation you have in mind is putting some structure that is improving the precision of your estimates and therefore the performance of the model. Okay. Cheap comment. I mean, of course, one of the beautiful lasso is that super simple. The theory, then the numbers is not. But I mean, again, if you look at the tables, I think it requires some work to look at the condition 1, 2, 3 that Olivier and coders put up. And as I said, like because this is in the tradition of the machine learning, of course, there is a consistency result. So don't look for rates or for inference. That is not the part here. However, because I guess this is what I like here. From Ghosh, we learn a number of things which are important. So, for example, the two parts of the risk premia, the knee and the expected return, they have very different speed. So the knee, for example, in a like dual asymptotics like here, has a very fast rate, like root n and t, where the expected return has a slower rate, which is square root t, which means that when you use them, it's a bit like when you juggle parametric and parametric feature of a model. You can assume need to be known, essentially, right, asymptotically. Right, and so I guess this actually could play a big role in the forecasting performance. So I think, like again, another paper maybe would like to use these properties, right, of the estimator to see maybe you have some accurate idea about the bands, for example. So this paper about the forecasting bands. So this paper, for example, essentially, I just put a very simple decomposition, right? Like the forecasting error, we have the sort of model error and nature. Right, so this paper is about this part. So if you combine those two, and maybe we can learn a lot from this structure, again from the no arbitrary structure. Maybe that could be super useful. Okay, so empirical results. So I mean, this is the first paper that Olivier used to motivate, and I think is great. It shows clearly that, you know, I mean, if you're talking about, like, you know, as you say in the realistic example, you know, the number of models, the number of combination feasible on arbitrage is 1 epsilon of every of the total. Then of course the lasso, which is kind of shooting the dark, is going to almost always to violate that. Okay. I find kind of interesting the fact that, you know, like half the time a good model is the starting model. Of course, this is also dependent on the fact that the starting model is imposed to be non-sparse, right? So that's which is so basically the model they're estimating is a tilting around the so it would be nice to elaborate more on the interpretation of that. I mean, just as a fact. And then there is an in-sample. The sample, this is the in-sample results. So I mean, I think Olivier gave the numbers. Is about a good improvement, about 12%, or between 8 and 15. I don't remember. Maybe, I mean, it could be a useful thing to maybe some sort of idea of how important it is. I mean, Frank Diebold, I don't know if he's connected, but I mean, maybe that's what he would say. But I think what is more important than that is the autosample. The autosample actually the improvement is even better. So that's actually, I was quite impressed by that. I would expect the other way around. But again, I think the parsimony of the model gets this kick. And maybe a couple of words on this. I mean, the paper could be probably useful to reassure the reader. Again, you know, if you want some measure uncertainty, I mean, Diebold Maria probably doesn't work here, but, you know, maybe there is something else. But you know, maybe, you know, some panel technique for forecasting, you know, performance, you know, some method. Then again, the large N, I think, will play a big role here. So I'm sure something can be done just to make it a bit more structured. And then I think, you know, I mean, of course, you know, I mean, who am I to tell you guys that, you know, like often like a very simple misspecified model is beating the correct model to sample. Okay, this is some sort of general idea. So, and I think that's really important here, in a sense that, you know, maybe as a simple way to convince our even more, you can say, why? What about if you impose other restrictions, which are crazy, let's say, but just restriction? And then if you see that actually the no-arbitrage are really delivering, I think that would be an amazing, right? I mean, it would be super clear that it's not just restricting, which helps, but restricted in the economic or meaningful way. Yeah, I think maybe that's, I mean, again, maybe something that is pretty simple to be done. And again, I mean, because I'm in love with the Gauss paper, and I like the misspecified part. You know, maybe we work to have some, you know, again, another paper you could maybe look at what happens if forecast with a truly misspecified model. We know we can estimate those models. We know we can parameterize them, etc. And, you know, and in Gauss they have the full theory. So everything is more or less there. So if you add the sparsity, then maybe you could do something there. Anyway, well, I mean, a really nice paper, very well executed. I mean, dense, so it's a warning, but, you know, I really learned a lot, as usual, from, you know, all the stuff that Olivier and Patrick and all the team are doing. So I really strongly suggest to read it. I mean, it's a great work. And thank you very much for offering me my time.
Thank you, Paolo. Olivier, you want to sort of respond?
Indeed, if you want to make a bit of confidence interval around the prediction, because it will be b hat I t multiplied by lambda hat t. So indeed, the new hat doesn't play any role because, as you say, it's super fast. So because we use a post-lasso or a post-OGL, in fact, you can get the usual interval that you will get on an OLS. So and then just apply the delta method on the product in order to have the confidence interval on the expectation. So this is doable in the well-specified case. In the misspecified case, this will be much more difficult, because in that case, the new hat doesn't have that super fast square root NT convergence, but it will be slower. And then we have to be a little bit more careful. Okay.
Another paper.
Yeah, it's another paper. Yes. So,
nice paper.
So Olivier or co-authors, anybody, maybe I have some thoughts. First of all, I mean, these linear loading representations go back to Fersen and Harvey, at least. I mean, it's been around for a while. I'm always nervous about these linear specifications of these characteristics in macro, because they may end up having loadings that are quite erratic in behavior given the input series that you have. But before I get to that, I mean, do you have any sense on which of the characteristics ended up being selected mostly by this?
In fact, we rushed a little bit late January to submit to a special issue on predictability. So we hadn't had it was just on time, just meeting the deadline by 1 hour. So we haven't done that. We did that in the paper with Inès Chayeb and Hugues Langlois in the Journal of Financial Economics, where we look at the ZT and ZIT -1, so how we select. And what we found, and this was a bit surprising, but it was another methodology, is that you don't necessarily select the size characteristic for the size factor, or the book-to-market characteristic for the book-to-market factor. It's often the case, I would say 60% of the time, but not 100% of the time. So it seems that there is a bit of heterogeneity in that. And of course, this is something that I guess that the referee will probably ask to get a bit of idea what type of characteristics are important in which industry, for which factor, etc.
Correct.
And so on.
Correct. Yeah.
Where I was really surprised is the as Paolo said, is that the 42%. So it seems that for a couple of, well, many stocks, in fact, a simple 5-factor model does the job.
A bit of a different question. I mean, I'm also a great fan of your paper with Elisa and Patrick. And you sort of really, insist on using individual stocks as opposed to sort of portfolios, which are used by a lot of people looking at these kind of questions. If you look at your out of sample performance, can you actually say something more about which type of stocks you're actually doing better, as opposed to? I mean, you're basically looking at this cross-sectional distribution. You look at the box plots, et cetera, but are you doing better on the big stocks? Are you doing better on the small stocks?
We haven't looked at that. But it's a good point. We should definitely look at that. We haven't. Also, it's an equally weighted. So we say in the paper, an equally weighted portfolio when we try to forecast. So as we say that it's related a little bit to a type of averaging, like Timmerman. Stuff when you just you average, but here you average in an equally in the cross section instead of across models.
Right.
But you have I have still doubts about except for for some stocks that for each individual stock you can really predict everything. So you need a bit of averaging.
Sure, but you can lump them, say, by a small stock versus large stocks, and it would actually be, I think, a more convincing. Well, your paper is convincing. I'm not arguing that, but if you actually also add to that you actually can locate where the improvements occur in what type of stocks, that actually would be interesting, I think.
Yeah, that's true. Yeah.
Another paper.
I don't know. It depends whether the referee will ask for it. Then it will be the same paper. So don't give.
No, I'm sorry.
Yeah.
There is a question from the audience. I've been wondering about the benchmark for the model. The prediction error can be misleading. It would be more informative to, if you can read the question too, right? I think, Olivier, if the prediction was compared to, say, a constant mean, or, I mean, we're basically looking at the benchmark model presumably for out of sample. This is a bit of Goyal and Welsh kind of arguments.
Yeah, okay. So we really took here the special issue is on predictability in finance. So what we did is to use the usual stuff that you do in prediction exercise. So there are plenty of other measures. Also, Paolo was mentioning the Diebold Mariano type of stuff. So then you can look at other metric to get to look at the prediction. But I think that the main results of the paper, which is So if you introduce explicitly finance theory and no arbitrage restriction, it does help. I'm pretty sure that that main message will remain true if we switch to other measures of prediction quality. You can really see that the lasso is really too noisy. So
sure, I agree.
So I don't see why the message would be different.
I'm afraid that we're going to have to close because we run a little bit out of time. Thanks again to everybody. We will be resuming at 1 o'clock, and Brian Kelly will be taking over as session chair. Have a good lunch, and see you later. Thank you.
Hi, everyone. Welcome back to the SOFI Machine Learning Conference. We're going to be starting our second session now. So our first paper is the knowledge graph for macroeconomic analysis with alternative big data. The authors are Yucheng Yang, Yuepang, Guanhua Huang, and Weinan. The presenter is going to be Yucheng, so you can go ahead and share your slides and we'll get started.
Okay. Let me share my screen. So now can you see my screen and hear me?
Yes, it looks great.
Okay, great. So yeah, thank you very much for having our paper on the very interesting program. So today I'm going to present my work on the knowledge graph for macroeconomic analysis with alternative big data. So this is joint work with Yuepang from Peking University, Guanhua from USTC, and Weinan from Princeton. So the basic motivation for this paper is traditional macroeconomic models, no matter DSGE models or structured VARs, we only have a small number of variable inputs. So recently, with the rise of big data and machine learning, now we are able to study macro with many more variables, especially those new alternative variables. So there have been two approaches in using big data in macro. Both have been super successful and influential. So one approach is to put many variables into the statistical model directly. The other is to study one no-few alternative variables in a time. Though those both approaches has been successful, there are some limitations on them. So for example, for those statistical models like machine learning models or factor models we have been using in macro, people always throw the data into the model without really understanding the relationships. So for those papers that study one or few alternative variables in a time, think about those papers in Nature and Science that study image, satellite image or cell phone data, use those data to study macro. Those papers all only use one or very few variables in a time, which is kind of not so systematic. So we think that we need a new knowledge system on the relations among traditional and many new economic variables to design those models more systematically. So this paper is an attempt toward that end. Here we want to build a knowledge graph of the relations among traditional variable and alternative data variables. So what is knowledge graph? Knowledge graph is one of the most popular notions in the age of artificial intelligence. It's essentially a knowledge base that uses graph topology to represent interlinked descriptions of entities. So look at this example of the knowledge graph of Albert Einstein. You can, excuse me. You can see the basic elements of the knowledge graph is those RDF triples with a form of subject, predicate, and object. So for example, look at this linkage. Here, the subject is a theory of relativity, and the predicate is proposed by, and the object is Albert Einstein. So these knowledge graphs has been very popular in the application of in many industry scenarios. So the most prominent application is Google search. So actually Google used a knowledge graph to power its search and search algorithms like PageRank. So here we are not building a knowledge graph for Einstein, but we are going to build a knowledge graph for economic variables. So like Google uses it to power its search engine, we hope to use it to power macroeconomic analysis with big data. So we are going to build a knowledge graph of relations among variables, and we hope to extract those RDF triples from academic literature and industry research reports. So there will, as a new kind of new knowledge system, there are many potential applications. And in this paper, we'll apply the knowledge graph of economic variables to do variable selection in economic forecasting. So for the sake of time, I'm not going through all the literature. But we are here to work on the big literature of big data and machine learning in macro. We also contribute to the recent literature of knowledge graph of scientific discoveries. So if there's no question on the motivation, so let me introduce the data and the methodology we are going to use in this paper. So as I say, we hope to extract those relationship among variables from textual data. So here the data we use in the paper is the industry macro research reports from China. So there are several advantages of this data. So first, those industry reports, they're always focusing on analyzing or forecasting the dynamics of some aggregate macro variables. And it's always clearly state that what variables people are studying in each report. So secondly, the nice thing about industry reports is that they mostly adopt the so-called narrative approach, which clearly states the logic chain of their analysis in narrative language, rather than in theoretical or quantitative models we commonly see in academic papers. The third advantage of this data is that it is freely available and can be downloaded massively from some database. So before I present the full algorithm we developed to construct the knowledge graph, so let me illustrate how we can extract the relations and variables using the following example. So this is a paragraph that studies the dynamics of inflation in China. So the paragraph say that a long-term systematic migrant worker shortage has appeared, and it increased the growth rate of migrant worker wages. Then it results in the increase of food price, which push up the increase in CPI and make the inflation higher. So as you can see, we hope to extract all the economic variable and the relationship among the variables and store them into the RDF triples. So if we can do this by hand, we can essentially extract the following 4 RDF triple from this illustration paragraph. So the first one is that we find, so the author of this report argued that the migration worker shortage would increase the growth rate of migration workers' wages. And the increase of migration worker wages would increase food price. Then the food price will push up the consumer price index. And also in this paragraph, it says that the food price will increase the inflation. So these are the 4 RDF triples we can extract from this paragraph. As you can see, there are actually some duplicates. So the last 2 RDFs are actually mean the same thing. So after removing the duplicates, we can get a small part of this knowledge graph. We finally get around inflation. So which clearly state the logic of how migration worker shortage would affect urban wage, how urban wage would affect food price, how food price will finally affect the inflation rate. So our ultimate goal will be do this thing more systematically for many textual data. So the general procedure we propose goes as follows. So the first step is that we finally hope to study some aggregate variable of interest like GDP, like CPI, like investment, etc. So we would first make a list of those aggregate variables of interest together with their variance. Then we can find all these aggregate variable and variance in the document using string matching. So next, so around all these aggregate variable of interest we find in the textual data. So we will try to extract all the other variables and the relations among those variables around this aggregate variable of interest. So I will talk more about this step because it is actually the most technical challenging part of our work. So after finding all these variables and relations around this aggregate variable of interest, we can store them into those RDF triples, and after dropping the duplicates, we can get the knowledge graph. So the most challenging part of this procedure is to automatically detect what are the variables and the relations among variables in the textual data. So this is called named entity recognition in the natural language processing literature. So most of the NER literature has been focusing on extracting names like human beings, names like organizations, but there have been no literature working on extracting entities for variables. So this is very hard because economic variables are mostly multi-token entities with complicated semantic patterns. So the example would include, so in the illustration paragraph, we can see the example like migration worker shortage, like growth rate of migration worker wage. So we actually also have more complicated variable entities like processing trade firm registration in China, like leverage rate of local government financing vehicle. It will be quite hard for us to detect those entities from textual data automatically. So to address this challenge, we will develop an active learning algorithm with human involvement to extract variable entities and the relation keywords from textual data. So what is active learning? Active learning is a form of machine learning when the labeling is very expensive. So we need an algorithm to tell us which data we want the human editors to label and want the model to learn from. So here, the active learning algorithm goes as following. So first, we'll start from some initial set of economic variables and initial set of relation keywords. So this is very easy to obtain. We can simply download the variable name from some database and we can get a long list of variable names. Then, using the current set of economic variables, we can train a language model to predict whether a phrase is a variable or not. Then we can expand the list of this variable set. So here comes the active learning part. Then we'll find those sentences with many variables but very few relation keywords. By the way, the relation keywords will be those words like increase, decrease, affect, impact, something like this. So first we'll find sentences with many variables but very few relation keywords. Then we use the human editors to find the relation keywords in those sentences to expand the set of relation keywords. Then similarly, we'll find those sentences containing many relation keywords but few variables. Then we will most effectively to use the human editors to find variables in those sentences. Then we go back to the step 2 to throw those variables that human editors has been labeling to the language model to build up model to predict whether a phrase is a variable. Then we will repeat step 3 and step 4 until convergence. So we can kind of extract, try our best to extract the variables and the relations in the textual data. So after this active learning algorithm, so we will get the knowledge graphs centered at different aggregate variable of interest. So this is an example of knowledge graph centered at inflation. So as you can see, so in this knowledge graph, first, we will have some traditional relations that we commonly see in the literature. For example, money supply is going to affect inflation rate. For example, the baseline interest rate is going to affect the inflation rate. But we will also collectively see many alternative relations that people has been mentioning in the reports. For example, the relation on how the agricultural labor demand affect migration worker shortage, how it affect urban wage and inflation, and so on. And so we also see that we finally classify the relation keywords into 3 categories. the positive relation, the negative relation, and the neutral relation. So the third thing we want to say about this knowledge graph is that, so as you can see, these linkages can be one layer or multiple layers. Also, if we can put some time step on the textual data we extract, so we can actually put some time varying weights on the linkages in the graph. So for example, in this knowledge graph of net export, we actually find that, so in recent years, there have been many research reports highlighting how processing trade firm registration numbers is relevant to the net export, which we can kind of build up a time varying knowledge graph. Okay, so with this, this kind of new knowledge system in hand, we can do a lot of things, like people have been using the knowledge graph in many real world applications. So here we are going to do a simple but concrete application of the knowledge graph, which is economic forecasting with many inputs. So here we will, the task for us is to forecast China's monthly inflation and the nominal investment for this 24-year period. So for 1 month to 12 months ahead, so we will hope to forecast these targets with input variables from the past 3 months. So usually when people do this kind of forecasting, the baseline model, what the baseline thing that people would do is to first find some standard time series. So for China's macroeconomy, there is a time series database constructed by Pat Higgins and Tao Zha, and they use this. We can use this standard time series as inputs, and then because it's high dimensional, people use some statistical method. Here we use lasso to do some model reduction. As a comparison, the knowledge graph based forecasting. So we will design these model inputs following the guidance of knowledge graph centered at inflation rate or investment. And we will collect as many data as possible following the guidance of knowledge graph. And then we will use, because it's still a very high dimensional model inputs, so we are going to use lasso to do some model reduction as well. So this page is just to give you a general idea of what variables are used in the baseline model and what variables are used in a knowledge graph based model. So essentially you can see in the baseline model, everything is kind of standard. We have GDP, we have M2, we have lagged CPI and GDP deflator, and so on. For the knowledge graph based model, so we not only have those standard macro time series, we would also follow the guidance of knowledge graph to include some alternative variables here, for example, like some commodity output, for example, like other variables like oil input and so on. So here we plot the forecasting errors in the out of sample testing set for both the baseline method and for the knowledge graph based method. So here, as you can see, so when the x-axis is the forecasting horizon ahead. So as you can see, in short-term forecasting, the two models are actually comparable to each other. But when the forecasting horizon increases, the baseline model kind of get worse and worse. But the knowledge graph-based model is remaining a stable forecasting error, and dominate the baseline model in long-term forecasting. So these comparisons are significant under Diebold Mirela test. And so we also look at the variable importance by calculating the reduction of R square when we remove the variables. So we find that the baseline model actually entirely rely on the lagged CPI and lagged GDP deflator to do the forecasting, while the knowledge graph-based model, they not only pick up the lagged CPI, but also pick up several alternative variables like commodity output. So another nice feature of this knowledge graph-based forecasting model is that it actually have some, guaranteed interpretation, because all the variables that in a knowledge graph-based model, it comes from some economic logic narratives. Instead, for the baseline model, so for the baseline model, there's no guarantee that the variables that you finally pick up from the statistical model that really is interpretable. So the final remark on this comparison is that, so in industry, there are some people say that the short-term forecasts mostly rely on statistics, where long-term forecasts mostly rely on the logic. So here it seems that the knowledge graph can better capture the underlying logic of the economy than statistical methods on big data. So similarly, we will find the similar pattern for investment forecasting. Okay, to conclude, so our paper introduced the concept of knowledge graph to study macroeconomics with big data more systematically. So here we develop an active learning natural language processing algorithm to build a knowledge graph of relations among traditional and alternative variables from textual data of industry reports. Because this is kind of a new knowledge system, there will be many exciting applications ahead. So here as a concrete example, we use a knowledge graph to guide us to do variable selection in economic forecasting. So the reason that motivated us to write this paper, so one important motivation for us to write this paper is that we are working on this broader agenda of studying macroeconomics in the age of big data. So beyond this paper, so this paper is about the knowledge system of economic variables. So beyond that, we will also have try to work on the kind of the knowledge system of policy objectives. So which is in this paper, ongoing paper on textual structure of government policy. The title is attributed to the nice work by Brian and Dutchen. And then we also, after we have this knowledge system of variables of policy objectives, so we want to think about this issue in the framework of optimal control. So we need some new tools to solve for optimal control problems in this high dimensional setting. And recently we have starting to present this new work that using deep learning to solve this high dimensional optimal control problem in economics. So we really look forward to see more work done in this agenda. And yeah, so this is a presentation for this paper, and I look forward to the discussion from Philip. Thank you.
Great, thanks very much, Yucheng. All right, so our discussant is Philippe Goulet-Coulombe. So you can go ahead and share your slides.
Okay, can you hear me and see the slides okay?
Yeah, you're all set.
Great, so it's like 15 minutes, right? So let's get started then. So yeah, thanks for the great paper. Thanks for the great presentation. By the way, I mean, this paper, I mean, is nice, introduces a lot of things. And, I think a lot of these things are somewhat exotic in nature. But when you get to read the paper, it's actually quite well written. So it really reads nicely, even though there's a lot of new stuff to be introduced. So that's good to know up front. There's no big language barrier here. So, but anyway, so the way I'm going to do this discussion, I'm going to obviously summarize a bit what we've just seen. And then I'll talk about, I think, what I could say the validity of the forecasting exercise, which is, I guess, more, like gathering a lot of technical points there. And then I'll close this discussion by, I guess, trying to ask bigger question than just that of the forecasting exercise validity. So first, some key points. So they extract a knowledge graph from about 900 documents discussing the Chinese macroeconomic situation. It's nice because it uses alternative data, and this is an area we want to use alternative data to build a better prior for variable selection. And variable selection in macro is a hard problem. There are many papers trying to do that. Sometimes the number of variable changes, the structure might not be sparse. So they're using new data to do that. I think obviously it makes tremendous sense to do so. Time series data is short, the economy is complex, so any prior information is welcome. And it turns out that people that write these policy, report, they have a lot of information to share. And actually, I spent myself some time in a department that was doing this sort of analysis before starting the PhD. Indeed, they have a lot of knowledge that perhaps we don't always have in our statistical model. So when I was reading the paper, I was like, yes, here's a nice way to bring that knowledge and try to make it useful for more traditional macro forecasting. And I thought, while reading this, it's interesting. I was just asking myself, could this knowledge graph machinery replace, the databases that we have, like Macroeconomic and Yang, the selected variables from Fred, and there's about 250 of them, I think, for the quarterly database. But could we use knowledge graphs to, in fact, know which database we should be using as standard when we do macro forecasting? And now, it's actually a Canadian one, and there's a UK one. And I was just wondering, maybe that's the way we want to proceed now. We want to, automate these things and rely perhaps on these sort of algorithm. And more generally, I remember reading some news article back at the beginning of the pandemic where they were saying people were using deep learning to sort of try to synthesize COVID medical research and just try to make, knowledge, you build faster. And really here I was sort of thinking, well, that's sort of interesting because, again, this machine learning somehow used to synthesize just a lot of knowledge and try to make something useful and harmonious out of it. So that's sort of the big picture. I thought, of course, that makes sense to do so. Great. Now, the unique validation of this paper for what they do, of course, they do the knowledge graph, it's all nice, but the unique real validation is the forecasting exercise. So I like to say, if you live by forecasting, you can also die by forecasting. So you have to make sure that it's, pretty solid. So I'll have some comments a bit on how to make the forecasting experiment a bit more convincing. I guess some points here will be a bit weird to people that haven't read the paper, but still, I think it's good to know. It's perhaps more the referee part of my discussion. So first, there's no big workhorse time series benchmark included to compare whether, it's really better than that, because Lasso, is good, and they use Lasso in a restricted set of variables. But if I want to forecast US inflation, I'm not going to use Lasso. I'm going to use, the random walks or the UCSV models or, stuff like that. So those were not included. So obviously you want to include that. Of course, maybe the Chinese inflation is behaving differently. That would be good to know. There was no big discussion of that. I think that would have been helpful. Then, they're using Lasso, but I think, you can use anything. This is just an algorithm taking an input, new inputs, right? And Lasso is good, but it's linear. It has limitation of its own. You could very well use random forest, boosting, or neural networks, because, at least the last two, they allow for nonlinearities. Maybe the nonlinearities are more prevalent when you do the KG stuff. I think, it's worth looking into. Forecast, I think they say they forecast 1 to 12 months ahead, but using inputs variables from the past 3 months. So that was a bit weird to me. Why not extend it? You're using Lasso anyway, so there's plenty of room. You can let the algorithm decide if only the last 3 months are useful. Now, they conclude that the better long-term performance of the KG-based model serves as a confirmation that the relationships described in KG correctly represent the true logic of the economic system. So, perhaps, yes, but I think it'd be good, obviously, to move beyond just looking at root mean squared error and look at the forecast and, have an idea of what Lasso selects. I think we had a bit of that in the presentation where there was something about commodity prices, but obviously we would like to see a bit more so that we can really back solidly, such statement. And then, I mean, it's just that in the paper, the discussion of how the evaluation is done is not so clearly laid out. So obviously that would be helpful just to make sure, you know, we're on solid grounds here. Now, just this one is a bit of a broader comment about how we can really tell, you know, if KG is doing what we want, right? Because there is this whole idea that it should select variables that are useful. So I think I like to use, so this little X here is the universe of all potential variables. And I'm really asking, how could we design an experiment where we can really tell that the KG is catching something important, not more and not less, right? You know, that's what we want. So the non-KG model, my understanding from the paper, has 12 variables. So obviously it could be it's a subset of the whole, all the variables you could use. The KG model uses much more variables. And in great part, it includes what is already in the smaller set of variables. So it's very hard to tell whether the KG model is doing better because it just brings a bunch of new data to the table, or whether really it selects what is useful, right? You know, these are two different things, right? You know, Lasso could be doing better only because I thrown at it more relevant stuff. So really, it'd be nice to be able to clarify whether KG find new variables, or, you know, if those are directly useful and more useful than what Lasso could in fact select out of a big database by itself, right? Because here, the alternative, if you think about US data, it would be to use the big X, you know, let's say it's Macroeconomic and A, and then you throw that in Lasso, and then Lasso selects, right? So you have, I think it'd be nice to know whether statistical methods, traditional ones, can do selection better or worse than KG. And I think the way things are done right now, it's a bit hard. To tell. So, and I actually, a random idea maybe is, you know, some hybrid approach could be to have like an adaptive Lasso. So Lasso usually selects everything, but maybe you could have adaptive Lasso, which we know to have the oracle property where the weights are given by KG. So I think, you know, there's a lot of things to think about, but I think this point that KG selects stuff better, I think, you know, a bit more work is needed here so that we're fully convinced. Last concerns about the forecasting exercise, perhaps it's all right, but it was not really specified in the paper. They're using articles up to today and the resulting knowledge graph. But then I was sort of wondering, how can we be sure in this sort of environment that we're not using the past, the future to predict the past a bit? I mean, perhaps they're doing these things recursively, but then we have to be careful if they're not done recursively. Because obviously, if I have a knowledge graph of everything that was written about the missing disinflation in the US after 2008, and then I have all this knowledge graph about this, you know, reverse engineering that we did to explain what happened, if I sort of use that to select variables to predict inflation after 2008, I mean, obviously, I'm sort of breaching the fifth wall of knowledge here, and that could help, but, you know, not in the way that we want, that at least what we observe as forecasting accuracy. So, you know, just clarifying these things, making sure we're not doing bad things here. Some other avenues that I think could be interesting. I was reading that, you know, the monthly data for China has 12 regressors, but the same data set by the same guys has 70 variables. So I think it'd be interesting just to use that as a validation, because I was really wondering, are we doing better because we're in a very data poor world, or, you know, because really KG is catching something else? And now the way the exercise is set up, it's a bit hard to tell. And I think, you know, something could be interesting, really, if you want to go on with this idea of variable selection, perhaps just running a small VAR with the original data and with the KG selected data, and just look at the IRS. Are they very different? Or we, you know, at least we would have something, you know, slightly more structural to say about what we have just done. And finally, that's my last word. I was really wondering throughout one big question. You know, how does KG differ, or what can, you know, new knowledge, you know, can it provide us that we couldn't get from running like a big VAR on all that macro data and then doing like a Diebold yield mass sort of connectedness sort of graph. You know, this one here, I remember, is a friend of mine doing it on a, I think, 20 variable VAR for the US economy. And then we see, that looks like stuff being connected. You have different stuff, exchange rate is disconnected, and you have the labor market. This is just using a VAR and lasso to infer, sort of a knowledge graph, but from, covariances in the data. So it'd be interesting to sort of differentiate the knowledge graph. Of course, it uses different data, but then the idea is do we get different knowledge, right? And, I guess I'll stop here on that big question, and hopefully Yucheng has something to say on all that good stuff. Thank you.
All right, thanks very much for a great discussion. Yucheng, do you want to take some time to respond, and then maybe we can have a few questions?
Sure. Yeah, thank you so much for the nice discussion. I think it's very informative, and I'm really happy that some forecasting expert has been carefully reading our forecasting section of the paper. And I really learned a lot from the discussion. So maybe I will respond to a few points that you have made in the discussion. So the first one is what do you say about how we are comparing the knowledge graph with the Fred MD, Fred QD work done in the US, UK, and Canada. So this is it's a great point. This is actually one of the motivation for us to start this knowledge graph work, because we see that when people in many papers that do big data in macro in the US, people just directly take the Fred MD or Fred QD and then test some models, and we kind of think that it's not cool because we don't really understand what's in the Fred. Okay, so what's the output of the Fred MD and Fred QD? So we kind of want to have some prior knowledge about when we want to forecast inflation, what's the variable we really want to use. So I guess so then we go to the textual data. So we finally use. Yeah, we have been. So one thing I want to say here is about this is it's not a paper about China's macroeconomy forecasting. We hope to work on this for macroeconomic research with big data in general. But as I say, so there are some advantage of the Chinese textual data. So that's why we use these industry reports in China. So I have also been look at the the US industry reports, but they are kind of expensive to download, and I'm not sure whether anyone have this kind of resources for me to do the same exercise. Yeah, that's for the first part. So I guess for the second point, I hope to talk a bit about is that for lasso, it's so we actually use lasso for kind of baseline comparison, because for both cases we are using lasso. So the thing that we are really comparing is that we use some so some maintained data and some knowledge graph guided data. So what will be the difference? Right? I guess I think your suggestion on the 70 variable versus 12 variable is also nice. But the reason that we didn't use the 70 variable is that so the starting time point for the 70 variable vary a lot. That's actually a big trouble when people want to do macro forecasting in China, because the economy has experienced a lot of regime switch. The modern time series data is kind of shorter than the US. Yeah, so I think another very interesting point that you made is about the forward-looking bias. Yeah, I guess this is a fair point that we are also been thinking about. But I guess so this kind of forward-looking bias is kind of common in many of the big data applications. So for example, we have read many papers in using machine learning to forecast risk premia. So, but actually, maybe back to the 80s or 70s, people don't really know that those variables are helpful for us to forecast risk premia. Maybe so. I guess this kind of challenge appear anywhere. But yeah, for sure it appears for our application because also those industry reports, the whole investment industry is is quite recent. So we definitely use more recent reports to pick up what variables are important behind the aggregate dynamics. It surely could be a problem, but it's not that big a problem because at least we don't use the current data to kind of provide some quantitative guidance on how much each variable could contribute to the forecasting of inflation or nominal investment. Yeah, I think the last thing I want to respond is that I really like the comparison of from knowledge graph to VAR and from VAR to knowledge graph. Yeah, I haven't think about this before, but I guess if we can find something common in between, that will be super cool to me.
All right, great, thanks. So we have a couple of audience questions. So why don't we take a few minutes to go through those? So
Sure.
First, I'm going to start with the second one. Could you explain how you determine the importance of factors in the knowledge graph? Because the description of relationships is qualitative.
Yeah, so we actually do not determine the importance of factors when we do the forecasting exercise. As I say, I just collect the variables as many as possible and put them into the model. But for sure, one can think about some work that really measure the importance or the kind of as I mentioned, the weight of each linkages in the knowledge graph. But yeah, maybe for some other reasons, I think. So I have been talking to some people on study, how expert belief has been changing over the time. So which is, you should definitely put some importance weights on this. Yeah.
Great. And then the other question was, because your graph has chained relationships, could it be more sensible to essentially use that in a more structured way, say a multiple equations model, rather than putting everything in a single equation together?
Yeah, so yeah, this is also an interesting question. So we do hope that we can put it in a kind of structural equation. But so those relations are mostly extracted from industry reports. They don't. So their notion of economic logic narrative is not the same as what we commonly see in structural modeling. So which make it a little bit hard for us to turn those multi-layer relationship into structural models directly. So yeah, but it will be interesting. So I guess even in semi-structured literature, there are a lot of ways to put some structure into a forecasting equation. So we are trying to explore this possibility, which is more feasible to us.
Great, thanks. And Eric Geisels has a question. Go ahead.
Yeah, I just wanted to build a little bit further on a comment that Philippe made. You're kind of facing a forecasting problem where you have to do both variable selection and selecting the lags for each variable. This was one of the comments that Philippe was alluding to. And Lasso is not really very well equipped for understanding the time series structure of the data, namely the distinction between variables and then lags of the variables. So we just haphazardly pick. I just wanted it's more of a comment or suggestion is that later on today, Andre Babi will talk about something called sparse group lasso, which is very well suited for forecasting in time series settings where you sort of allow yourself to make decisions on the one hand about variable selection, and then within the variables that you select, you will have to make a decision about the lags, and that's a better structure in order to sort of address the forecasting problem in a time series setting.
Yeah, thanks for the suggestion. We'll think about this and try that. Thank you.
Okay, great. So I think we should move into the next paper now. All right, so we're very happy to hear about the aggregation of probability assessments, regularized mixtures of predictive densities for Eurozone inflation and real interest rates by Frank Diebold, Minchul, Shin, and Boyuan, Zhang. Frank will be presenting, so Frank, feel free to take it away.
Great. Okay, that looks okay and sounds okay?
Yeah, looks good.
All right. So happy to be here. Thanks a lot for inviting me, inviting us. Always a great pleasure to be with Sophie, and a pleasure actually to have Alan Timmerman discussing this. He's definitely a key ancestor to this paper. So it's all good. This is joint work with Minchul Shin at the Federal Reserve Bank of Philadelphia and Boyuan Zhang, a grad student at University of Pennsylvania. So let me get right into it, given the time constraints. You know, there's lots of, I'm going to spiral in a little bit, but we'll try to get quickly to the meat. But there are lots of interesting issues percolating in the background, so I might want to highlight some of them. Obviously, sort of aggregating information across heterogeneous agents is something that comes up everywhere in economics, and certainly it's going to come up today, and that's what this is all about. A little more explicitly, it's all about forecast combination, but a big part of what we do is going to be under the umbrella of what you would call ensemble averaging, which comes up everywhere also in modern statistics, machine learning, econometrics, and so on. We already heard Philippe mention random forest. That's a great example, but so is boosting and bagging and all sorts of other modern algorithms. Regularization, of course, you know, sparsity, shrinkage, selection. I won't say anything more there. You all know all about that. Another thing that's going to be of interest in what we do today are real-time surveys. I mean, the real-time aspect is going to be important as well. You know, we're going to be aggregating information sets of heterogeneous agents, as I said, but that's going to be in real time as well. And last but not least, it's just a little bit of an aside. I won't do very much with it, but it's interesting to notice that what we're going to do today are big data methods, kind of regularization methods, but in very small data environments. The relevant data set here is going to be the ECB survey of professional forecasters, which is basically 30 people over, you know, 80 quarters. I mean, almost comically quaint by big data standards. It is comically quaint by big data standards. But what's interesting is that the number of regressors, if you will, if you want to think of it that way, is still very large relative to the number of observations. And that's where regularization is relevant. Even in small data sets like that, we're going to have, in fact, fewer observations than regressors, even though it's a small dimensional data set. So kind of big data methods, but for traditional small data problems in this case. So a little bit of background just to get our feet wet and let us get into what we want to do, which is combining, you know, taking mixtures of densities. But some of the lessons from the point forecast combination literature are crucial and sort of provide the takeoff. So let's do that. Let's remind ourselves that, you know, optimal combining weights in general are not equal. So here, of course, I've got, you know, just a little example, two forecasts, F1 and F2, convex weights, omega, 1 minus omega, C is the combined forecast. Of course, going back a half century, you know, to Bates and Granger, everyone knows the optimal weights depend on the ratio of the forecast error variances. It depends on those variances only through the ratio, and also, of course, the correlation. You're just forming a portfolio of forecasts. So as always, the optimal portfolio shares depend on the variances and covariances of the underlying assets. So fine, but notice that, you know, as always in a portfolio, the optimal shares are not equal in general. But let's remind ourselves of this as well, at least in forecast combination settings, even though, even though the optimal weights aren't equal, they're probably not far off. Like here's a realistically calibrated situation. I've got the variance ratio phi at 1.2. So one guy is 20% worse than the other guy, and the correlation is positive and pretty big. That's typical for economic forecast as well, around a half. And you can see that, you know, the optimal weight here is around 0.4. What's graphed here is the variance of the optimally combined forecast. And so the optimal rate is around 0.4, but you see it doesn't get you much more than just using equal weights of a half. And doing anything like that is radically better than doing nothing, right? If you just use forecast 1 alone, you're up here. If you just use forecast 2 alone, you're way up here. You go down really quickly just by doing any kind of blending, even if you're not exactly at the optimum. So Before we take off into mixtures, just note that a lot of the stuff I just went through is more restrictive in the point forecast environment than we really need. Of course, well, I didn't actually require these weights to be non-negative, and they do not have to be. You know, in a portfolio analog, again, you can short sell. But the weights needn't sum to one. I made a convex combination here, but it doesn't have to be convex. We could put in an intercept, even though we didn't. And that's what the other people like years and years ago, like Granger and Ramanathan emphasized. Basically, we're just doing an OLS regression, a projection, right, of reality on some forecasts. And, you know, we don't need to exclude an intercept. We don't need to constrain the weights to be non-negative or to sum to one. Those might just be unnecessary constraints that degrade the optimum. So people don't do that in general for point forecast combination. But we're going to see how different things are for density mixtures. But one thing that comes out of this clearly is that equal weights is an obvious shrinkage direction, right? So if you want to think about regularization, and that's where the point forecast combination literature has gone, you know, you're selecting in shrinkage, but it's not towards zero. That's going to be optimal for forecast combination, but rather toward equality, toward equal weights. So you might first want to select to zero, and then, but at any rate, eventually you're going to want to shrink the survivors, not toward zero, but toward equal weights. You could do something else, but equal weights comes up again and again and again, as we just saw in this literature, and we saw why. So that's, for example, what I did with Minchul, Shin, one of the co-authors in this paper, in an earlier piece, but just for point forecasts. All right, so let's jump into density forecasts now. A lot of things change, okay? And of course, that's what we really want to do. Density forecasts are the ultimate rich probabilistic statement. If you know a predictive density, of course, you could take its mean or median or mode or whatever and get a point forecast, or you could make intervals. You can do whatever you want, but the density is the full summary of everything relevant. So the first thing to notice is the point forecast regularization objectives are nonsensical. Remember, if we go back to something like this, you know, there's an objective and there's a penalty, of course, in any sort of regularization that you might want to do. But in point forecast environments, the objective is something like a sum of squared errors or whatever loss function you're doing. But let's say quadratic, so it'll be sum of squared errors. But you know, you don't have errors in a density forecasting environment. The forecast is, you know, you can't subtract a forecast minus a realization. The forecast is a whole density, and you know, so that's a problem with the objectives. You can't just port them directly from point forecast considerations. And of course, the penalties are hopelessly deficient in a way that might be obvious to you already, but I'll dwell on it in just a second. So let's back up again. You know, we've got some penalty here in a lasso style environment. It's a penalty on a sum of absolute coefficients. You know, here centered around equal weights, but it's the usual lasso penalty. Those sorts of penalties aren't relevant, or are just missing something massive, of course, in density environments. So let's fix this up. Here's what we're going to do. We're going to be working in a regularized environment for mixture formation, but we're going to, you know, figure out some objectives that make sense, and we're going to look at several, and we're going to figure out some penalties that make sense, and we're going to look at several, and then we're going to work with that and do some stuff, eventually focusing on Eurozone inflation. In the paper, we talk a little bit about real interest rates also, but of course, the dominant feature of ex-ante real interest rates is expected inflation. So that's really where the action is. So for this talk, I'll just focus on Eurozone inflation. So let's look a little bit at objectives. So again, you can't do things like sum of squared errors. You don't have errors. But you know, there's lots of things you can do. The kind of obvious thing to do, or the most popular thing to do, going back to good, you know, again, more than half a century ago, is the log score. The log score is just the predictive density or the predictive likelihood evaluated at the realization that actually winds up happening. Okay, it's that simple. So here it is in indicator notation. It's the probability. Here I've written it out for a discrete environment. I might bounce back and forth between discrete and continuous. It's no big deal, of course. Sums, integrals, you know, it's all the same thing. but it's easier sometimes to write one way or the other. But just the probability assigned to the event that actually winds up happening. And, you know, it's a log density, and you put a negative sign to orient it so that smaller is better, just like with MSE or something like that. But, you know, all this is the log predictive density or log predictive likelihood evaluated at the realization. So immediately it's got an obvious frequentist appeal. It's also appealing from a Bayesian perspective insofar as the log score is a so-called strictly proper scoring rule. You maximize your payoff by truthfully revealing your density if you know you're being evaluated by a log score rule. That's what it means to be strictly proper. So that's all good, the log score. You might know others like the Breyer score. There's many the scoring rules. Not all are strictly proper. The Breyer score is, though, as well as the log score. It's just an immediate analog of quadratic loss. You know, the sum across bins in a discrete environment of the probability assigned to the bin minus, you know, a 0-1 realization. Was it in the bin or not in the bin? And averaged across the bins. And in the paper, we discussed many others, or at least several others, and, you know, objectives and some relationships among them. There's some interesting relationships, but for now, given the time constraints, I'm going to just highlight two of the more important ones, which we just did. And of course, those are like point likelihoods or point Breyer scores. If you have a sample over time, you just add up the point likelihoods to get the full likelihood. And we might have more than one forecast, of course, as well. So we're going to have cap K forecasters, cap T time periods. Of course, we've always had cap N bins in our discrete density. So there it is for the log score and for the Breyer score. Okay, so I've just said a few things about objectives. That's fine. Now let's go to penalties. Okay. The big deal about penalties for density mixtures, of course, is that there's something that always has to be imposed, and it's just the thing that doesn't have to be imposed for point forecast. So people like Granger and Ramanathan explicitly advocated not doing it, and that is non-negativity and sum to one. Of course, we're going to be forming density mixtures if we want them really to be densities. You know, the combining weights have to be on the unit simplex, which is to say they have to be non-negative and sum to one. Now, notice that this itself is a form of regularization, a definite form of regularization, right? You're putting a lot of structure on those weights. So here's the basic setup that you can't escape. You've got to have some objective, and I used the log score objective here. You could do other objectives, but for the reasons we just mentioned, the log score is actually a very appealing and kind of central objective from both frequentist and Bayesian points of view. But we've already got a constraint going on, the unit simplex constraint, and we're not going to regularize toward it, like sort of shrink toward it or something. It must be imposed exactly, okay? Or the whole situation is just not well defined. So this is going to be, you know, the basic environment. And notice that this is like a lasso penalty. I mean, it's a penalty on the sum of absolute coefficients, because the combining weights here are non-negative. So their absolute values are, you know, they're equal to their absolute values. So this sum here is effectively a sum of absolute values. Okay, but it's like you're putting a Lagrange multiplier of infinity on it. You're not coaxing things in that direction. You have to force it. It must be imposed. So you're kind of you sort of have your hands tied. You're like in a lasso environment, but you know, there's no more room in some sense to do other lasso things. So, but you might want to, because as we said, you might want to shrink weights toward equality. And you know, the unit simplex, of course, in general, is not equal weights. Equal weights is just one place on the unit simplex. So what are you going to do? Well, there's a lot of things you could do. You can do other sorts of regularization, of course. So here I've got like a log score objective, but with a ridge, you know, a ridge penalty. How much we shrink toward equal weights here, of course, is a function of the Lagrange multiplier lambda. But throughout, we're imposing the unit simplex. That's always imposed. Then the question is, how do we overlay other sorts of regularization on top of that. So you could, of course, do like a simplex plus ridge. Here's something that we've spent a fair amount of time playing with and really are intrigued by. So I want to mention it, at least for a second, although we won't go all the way down this road in this talk. But here I've got a different kind of penalty. We call it a divergence penalty, because notice the following, just a trivial insight, but it's important. And that is that you can think of the combining weights as just probabilities assigned to a discrete distribution on the unit interval, right? They're just a set of weights. They've got to be non-negative and sum to 1. So think of them as probabilities on some discrete distribution in the unit interval. If the weights are equal, well, then it's a uniform distribution on the unit interval, but they don't have to be. So D here is a measure of distributional divergence between your combining weights and equal weights, on the unit interval. And the thing is, all sorts of stuff about divergence measures in statistics, right? Some of the most famous stuff, right? Kullback-Leibler divergence, Cramér-von Mises distance, Cressy-Reed distance, Hellinger distance. These are like some of the most famous things by some of the most famous people ever, thinking about divergences between distributions, and they feature in a lot of important things very prominently, of course. So we know different measures of divergence for distributions, and we can use some of them. In particular, what I'm going to show you here is what happens if you use a Kullback-Leibler divergence measure here. What happens is, well, here is Kullback-Leibler distance. This piece out here is just a constant, so that's uninteresting, doesn't do anything. The important thing is right here. So if we use that as our divergence, it keeps weights away from 0 because the one way to phrase that is to ask, is some regularization strategy actually the Bayes rule? Is it a posterior mode for a well-specified likelihood and a well-specified prior? And the answer here, in what I've just shown you, this divergence approach with Kullback-Leibler divergence is yes. So in the appendix, we show in detail that, in fact, this so-called simplex plus entropy regularization is the posterior mode in a Bayesian problem where the pseudo likelihood is the log score that we've emphasized, and the prior is the Dirichlet. The beautiful thing about the Dirichlet is that it's only defined on the unit simplex, right? So that's automatically imposed on in the background, right? Positive probability is assigned only to the unit simplex. And then for a certain hyperparameter value, it's got a mean of equal weights. And then as you move that hyperparameter, you vary the shrinkage strength. But Dirichlet does everything you need. It enforces the unit simplex and lets you shrink toward equality. You combine that with a log score objective, and amazingly, at least for me, you get this Kullback-Leibler divergence-based regularization. All right. Now, there's another thing going on, and that's subset averaging. It's a little bit different, but very much related to the kind of regularizations that I've been through. It's just, I mean, it's a super regularization, right? In a subset averaging, you just pick a few forecasts, let's call it 4, because that's what I happen to do on this slide down there. And you throw out all the others. You just set their coefficients to 0, if you will, their combining weights to 0. And then you look at all possible 4 averages, or 4 and 3, or 4 and 3 and 2, or 4 and 3 and 2 and 1. And you see which would have done best. Had you used it up to now? And you use it. And then you go forward a period and do the same thing and go forward another period and so on. So at any given time, you're just looking over history and asking which of all the possible averages, and let's say it's an n max equals 4 average, there are many of them, right? With 19 forecasters and a maximum of 4 forecasters in the average. There's 19 choose 4 and plus 19 choose 3 and so on, about 5,000, but that's nothing, right? You do it in a second on your laptop, evaluate a few thousand simple averages. It turns out that kind of very strenuous regularization, throw out the losers and then just take a simple average of the survivors, takes you to good places. There's a lot of evidence in the point forecast combination literature that that's true. You might suspect it would be true here. It may or may not actually be true. We'll see. But we're going to take a look at that as well. One great thing about it is that the shrinkage strength, the choice of tuning parameters is done implicitly. You're just by brute force checking out every possible average. So that's happening inside. Whereas if you do something like one of these, you've got a lambda out there, right? So in real time on real data, you've got to take a stand on lambda. And of course you could do some cross-validation, but you're in tiny samples of highly serially correlated data. You know, cross-validation is not very appealing, not very likely to succeed. Here, in addition to putting in a fair amount of regularization automatically, the tuning parameters implicitly selected automatically and adaptively, period by period. You know, which forecasters are going into your best 4 average, you know, is changing as you go through time in general. All right. So anyway, we've talked now a bit about objectives and a bit about penalties. And as is the custom in talks, I'm going to skip the Monte Carlo, but rest assured it's there and the techniques work. You know, we can design credible, reasonable, realistic environments where we got to get a lot of gains from this shrinkage. But I'm going to go right to the empirical work because I definitely want to talk about it. But before I do that, let me give a ridiculously brief literature review. You've noticed that I've intentionally not mentioned any literature in the paper. Of course, there you know, dozens and dozens of references as appropriate, but I didn't want to clutter things up too much. But I should say a little bit. And you know, I started with point forecasting, and I actually have mentioned the names Bates and Granger Ramanathan. But then moving into densities, an early paper by Huang and Minchul that isn't as well known as it should be, you know, started doing density mixtures and noticed some of the things that we've noticed. And then, of course, Gaetan and Amasana, which is, you know, more well known, did as well, you know, adapting both in objectives and penalties to mixture sorts of environments. The real breakthrough in my mind comes in a paper by Giannoni et al. In the proceedings of the National Academy of Sciences, which it's not well known, but that's where they really started thinking about regularization. And they noticed that the simplex constraint, which always must be imposed, as I emphasized, is itself a form of regularization. And, you know, they weren't talking about forecast combination. They were actually doing portfolio allocation, like financial asset portfolio allocation. But again, the problems are intensely similar, if not identical. So there are some really good insights in this paper. And then Graham Elliott, in an unpublished working paper some years ago now, really started thinking about subset averaging, as I just emphasized, and started getting some really good results for point forecasts, but the same sorts of things can be done for density forecasts, as I've started to indicate. And then I did mention my paper with Minchul that did regularization sort of methods, but again, in point forecast situations. All right, so I'm going to skip this Monte Carlo. So now I've got a check next to the Monte Carlo also, and we're going to go right into Eurozone inflation. But it's in the paper if you want to take a look at the Monte Carlo. So because I'm really intrigued by these results. I mean, we always viewed this as a substantive paper and wanted the application to be much more than just an illustration or something. And I think it is. But I didn't realize, I never anticipated the results. The results I think are really interesting, and I hope you'll agree. So here we go. So here's the background. So there's the ECB SPF, the European Central Bank Survey of Professional Forecasters. It came online when the bank came online in like 1999. We're going to be looking at 1 year ahead forecasts. They're made quarterly, so there's a 3-period overlap. No big deal. These are density forecasts, of course. There are 9 bins in the histogram. The actual number of bins has evolved over time, but we can go back and collect things into 9 stable bins so that everything's okay moving through the whole sample. And at any given time, there are about 25 forecasters in the pool, density forecasters in the pool. But you know, there's entry and exit of forecasters. Different things could be done. We did the simplest thing, which is just take the subset of forecasters who've been there the whole time, or at least who never had more than one missing observation, which we interpolated if there was a missing observation, just the usual things that you would do. You know, we could discuss more sophisticated ways to handle holes and entry and exit and rough edges and, you know, unbalanced panels. But I'm pretty confident in how we set that up. We rely on Alan. Actually, Alan Timmerman pioneered the method that we use, so I know he'll have no problem with it. We thought it was clever. We stuck in a 19th forecaster with a uniform predictive density. That's analogous in some sense, whose predictive density is always just a uniform, equal weights. It's sort of analogous to including an intercept in a regression-based point forecast combination. I mean, so that 19th forecaster could get no weight, as it turns out, but it might get some weight. You know, it can't hurt. It's like an intercept, maybe to pick up some bias or something like that. So we put that in. The estimation is going to be rolling. We do different windows, but the basic benchmark is a 20-quarter rolling estimation. So that's what I'm going to show you. We burn it in for 5 quarters at the beginning, and then we start real-time, you know, forecasting, starting with the first quarter of 2001 and proceeding through the end of the sample. So just to take a look at the data or get looking at things, here just these gray frequency polygons are the individual forecasters back in 2004, and here's some quarter up in 2018, just some random quarters. The orange is the average across all of them, just a simple average, okay? Which again is not necessarily what we want to do at all. That's the whole point, but just to give you a feel. And you can see there's been some shift, you know, things shift around, the densities shift around. For example, you know, this high bar right here is much lower right there, right? And this fairly high bar right here is much lower there, you know, so, you know, the direction of skewness changed a little bit, for example, in these 2 quarters relative to each other. All right, so let's look at how the different things did, okay? So here we've
a little bit over time, so.
Oh, sorry, okay, I'll speed up. I can make it like in a minute.
A couple more minutes.
I can make it in a minute or so. So I must have mistimed. Okay. Anyway, let's look at how these people did in the ECB SPF survey. The ex post best person had a log score of a little above 2, and you can see the worst was 2.5, and you know there are some of the others. The median was at 2.17. So those are just the raw forecaster, the raw ECB forecast and how they did. How are our sorts of things doing? They're doing better. Here's simplex. Just simplex gives some regularization. Here's simplex plus ridge. By the way, this is the ex post best. Of course, you don't know who's going to be ex post best until after the fact, okay? But these are real time, right? And we're doing better than the ex post best, subject to one important qualification that I'll mention in a second. And here's the best 4 average, which is also better, and it's not subject to the qualification. And what is that? That is that simplex plus ridge and simplex plus entropy here we've tuned them using the ex post optimal Lagrange multiplier for the regularization. Of course, you don't know that in practice, but again, the subset averaging doesn't require that. It's implicitly done inside it, and it's doing just about the same as those other methods. So we're beating even the ex post best ECB person. You might wonder, what does a good old equal weights mixture do, though? I haven't shown you that yet. Well, there it is. We're beating it too, but it does pretty well. It's, you know, it's still beating even the ex post best from the SPF. So let me take the remaining 30 seconds or so and show you something that's really cool in terms of the substance here. So what I've shown you here is like, yeah, we do better even than the ex post best guy in the SPF, you know, fine. But let's see how we do better, okay? Here's the simple average mixture, okay? It is what it is. Yeah, so the over time going this way, yeah? So at each point in time, we have a mixture density by simple averaging, or here by simplex, or here by a best less than or equal to 4 average. What does the regularization of these two things do, right? Well, down here, what it does is it takes probability mass lower here and moves it up, like from 1.5 to 2 or 2 to 2.5. It moves it a little bit rightward. And what does it do in here in later years? It takes this fairly peaked mountain here, right, and smooths it out. Look how much more smooth it is there, and how much more smooth it is there relative to in the simple average mixture. Look at it this way, you'll see exactly what's going on, because here you've got a picture also of the inflation rate. So what this is in this heat map, red areas are areas that the regularization adds probability mass to of the density. Okay, blue areas are where it takes it from. So you see in these early years, the regularization is adding probability mass a little higher that it mostly takes from a little lower, like right below there, okay? And the 4 average does that as well. Whereas you see up here, it's not that way at all, right? What it's doing is taking away probability mass from the middle of the density, that's where the blue is, and putting it in the tails, in both tails, upper tail or lower tail. So up here or down here, the regularization is lifting the density a bit toward higher rates, and you can see that was a good thing to do. But this is all in real time ex ante, totally honest. And up here, what the regularization is doing, it's saying, well, it's centered okay, I'll leave the centering alone, but I want to fatten up the tails, both the high tail and the low tail. They're too tight. There's actually more uncertainty than the simple average mixture would tell you. And where does this split change? Where does it go from this regime into the other regime? Well, where is this? It's exactly as we exit, you know, the Great Recession. It's exactly when the Great Recession ends, first quarter of 2009. So all this one kind of regularization is during the Great Recession, and the rest is coming out and being out. Sorry for going over time, but I'll leave it at that.
All right, thanks very much, Frank. All right, Alan, we're ready for you. Our discussant's Alan Timmerman. Take it away, Alan.
Yeah, do you see my slides?
Yes, all good.
Okay, sounds okay. Yeah, my first impression when I saw the paper was that yeah, no shrinkage has been applied to the length of the title. This is probably, at least by my count, Frank's longest title I can think of, and I've read many of his papers. It's a great paper, and I really enjoyed reading it. Has a lot of very neat insights. I'll sort of like focus on, you know, sort of some of the big points. So, you know, Frank already did a terrific job sort of relating it to the some of the ancestor literatures. But let me just, you know, do a little bit of the same, and then sort of, particularly as you might expect, charge down the path of, you know, optimal point forecast combination, because I think there's some insights and some parallels we can benefit from there. Okay, so what the paper does, it explores, you know, regularized mixtures of discrete density forecasts using these linear opinion pools. It does a very thorough job looking at, you know, multiple objective functions, log score, Bria score, ranked score, multiple regularization schemes besides simplex, of course, then simplex and ridge, simplex and diversions. And then in a very interesting indeed empirical application to the European SPF density forecast of Eurozone inflation, it sort of finds, and I agree with Frank that those results are very, you know, enticing and novel, and also actually economically interesting. In fact, the regularized mixtures outperform every single individual forecast or even selected exposed, as well as the equal weighted average, which my prior would have been that it would have been particularly hard, as we know from the point forecast literature, to do. So just a brief recap of the setup, because I'll be using this notation. So there are M discrete outcomes or bins, so little BM indexed there. And the outcomes YT is then assigned to each of these bins, and the authors do a very careful job doing that. There's a lot shifts in bins over time, how they're positioned and centered, etc. So there's actually a lot of work. Then individual case probability forecast for each of the bins at time t is denoted PKT, and then we can stack them in a time series vector of individual probability forecasts. All right, so now we've got our notation in place. And then sort of like the lead objective function, also in the empirical application, is this log score objective function. And that takes this form here when we have these M bins, right? So one is just an indicator that tells us whether or not the outcome actually fell in the mth bin, and then PMKT is the probability at time t, ex ante probability assigned by survey participant little k to the mth bin, right? Okay, and then the final building blocks are, well, it's a linear opinion pool with big K forecasters, so some linear weighted average. And Frank already mentioned that there are some really interesting papers that have helped to trail that path to use this setting. And then with a simplex constraint, right? So the individual combination weights have to be greater than or equal to 0 and have to sum to 1. And you'll see that one of the things I'll emphasize is indeed with machine learning and regularization, insofar as possible, we should use economic insights to set those parameters if we can. We can't always do it, but if we can, we should do it. And so, for example, here you can see there's no short selling of the probability forecast, and there's no leverage. That's another way of putting it, right? Which seems sensible setting. All right. Now, then there's a interesting discussion of different penalty regularization schemes. So, Frank already talked about that, so I'll skip through that. And also with the subset averaging, which performs quite well. Okay, so a couple of comments on the context. So, certainly the linear pool is dominant in the literature. There is another literature that has looked at alternatives. So, for example, logarithmic combinations of product type kernels here. And so, for example, Genest and Zidek is one paper that comes to mind. So that might be interesting also to explore, just like an aside comment. But I will concentrate my comments mostly on parallels and insights from combination of point forecasts. So what do we know from the huge literature on optimal combination of point forecast? Well, one thing is that complex forecast combination methods that attempt to select the optimal weights, they tend to lead to unstable weights, perform worse than simple combination weights or the best individual forecasts, and they're often hard to beat. We often find that it's hard to beat a simple equal weighted average, right? So that's kind of the prior that I came in with, right? Probably many of us would have come. And one of the reasons why it's so hard to beat a simple equal weighted average is because correlations in point forecast errors are super high. We're talking about 0.9, 0.95 oftentimes in survey forecasts, right? That's going to be very different, because what you saw with these nice density graphs that Frank started off with in the first graph, I think, for the empirical application, there's a lot more difference. There's a lot more, differences across these individual forecasts when you look at the peaks, and then because assigning probabilities to bins is a very sort of like subjective thing, and I think that actually induces more heterogeneity in density forecast or bin forecast compared to the point forecast, which actually raises the hope that we can get more bang for the buck when it comes to combining density forecast than when it comes to combining those darn point forecast, because the errors are so highly correlated through time, right? So that's raises hope. Now, Frank already did this. He didn't give this formula, but he certainly was down the path, right? So he gave a more general formula here. But so imagine that we have 2-point forecast, y hat 1, y hat 2. Forecast errors, E1 and E2. We just assume that the forecasts are unbiased. So the errors are mean 0. We have the variances sigma I squared and covariance sigma 1, 2. Well, in that case, we know the Bates-Granger result, which says that the mean squared error optimal combination weights take this form here. And what you'll notice is that the optimal combination weight can be negative if sigma 1, 2 is greater than sigma 2 squared. And that's because one forecast here is actually used to offset the prediction error of the other one. Clive Granger used to tell this funny story that apparently he had a paper where he found a negative forecast, a negative weight on a forecast. And this friend of his who was responsible for the forecast got very upset. He said, "Does it mean you put a negative weight on me when I produce my forecast?" But of course he could explain, no, there's actually value in your forecast because it helps offset other people's forecast. Now in density forecast combinations, weights cannot be negative. It's very clearly explained why in the paper, right? But then you might say, well, we have, we are more constraints in density forecasting, so maybe it doesn't work so well, forecast combination for densities, as it could do in point forecasting, because we don't get maybe the same scope for portfolio diversification. Well, let's see. So to address whether that's the case, we must understand what the drivers of the optimal density combination weights. So we know from Bates and Granger that variances and covariances of the forecast errors are the determinants of the optimal weights. But what are the drivers of the optimal combination weights in density forecasting? Frank mentioned bias. So that was the uniform density. That is the 19th predictor here. Is it tightness of some forecast versus dispersion in some periods? Is the covariance-like terms? Is it co-skew? We don't know. So let's look at that. So let's look at some frameworks where we can analyze that, and get closed form solutions. Okay, so an optimal combination of two densities, what would it look like? If we go with the log score objective, you'll see that you can't go too far. So imagine that you have this, so this is the general, so you're combining P1 and P2. Those are two density forecasts, right? And they have weights omega and 1 minus omega. Suppose you just have two observations, so big T is sample size is 2. Then you take the first order condition, put it equal to 0, and if, assuming that the optimal weights lie in the unit simplex, you'll see that they actually take this form here. So if you play around with this a little bit, you'll see that it's extremely sensitive to these likelihood ratios, P1 over P2 at time t and P1 and P2 at time t plus 1. And equal weights are in fact optimal if and only if the sort of likelihood ratio at time t is the inverse of the likelihood ratio between the two densities at time t plus 1, right? But if you're a little bit away from it, you can actually fiddle around with this. Then the weights go absolutely crazy, right? I mean, and they lie outside the simplex. And so what you'll see is that actually regularization is really called for, because if you have a bin probability assigned, which is very close to 0, then some of these ratios can be very, very high, right? And so regularization is particularly important when it comes to combining density forecasts. That's the first insight. Now, this was for t is equal to 2. I could get analytical results. So I said, well, all right, let's try t equal to 3. And what you'll see is that the optimal value of omega, the weight on model 1, it actually is second order polynomial, and it takes this form, which depends on the ratios of these the differences in density scores here, log scores. So it becomes messy, right? So you can't really analyze it it's hard to get a result out of it. So instead, if you go with the Bria score, set here, Frank already defined it, then you take the first order condition, you get this results. And what you can show is actually that if you consider the Bria score with m discrete outcomes, the optimal weights on the two density forecasts take this form here, or in the population, right? So it basically, imagine that that the first density can help, so it's higher than the second density, right? The probability assigned to the mth bin. in cases where actually the probability that the bin occurs, that the outcome falls in the nth bin, exceeds what was predicted by the second forecast, right? So it's very, very intuitive, this result, right? So forecast 1 gets a bigger weight if it assigns higher probability than forecast 2 to categories occurring more frequently. So this is an unconditional result, but you can also go in and define it conditionally, right? And then you can do things like, forecast encompassing tests, right? Where you can go in and look at, does one, discrete density forecast actually add any information to another? Which sort of goes to, Frank has this paper on the egalitarian lasso, and sort of like this, which related to this, ellipse where you first trim and then you shrink, right? So it could be used in that context. But actually, you can go back and answer this question: what are the drivers of optimal combination weights? And you can see actually, certainly for the Bria score, it's this thing. And for some of the other things like the log score, it becomes things like this, tightness, right? But you just can't get the same analytical solutions. Okay. All right. So I think it's a really, really nice exercise to actually go in and understand these drivers, and they can be quite different, but and yet also intuitive when it comes to density forecasting. All right. So Frank described already and introduced the empirical exercise, right? And just to fully appreciate it, because I've also worked with this data there. There's lots of implementation challenges, so it takes quite a bit of effort to look at this data. I mean, there are forecasters with missing observations, bin numbers, and the definitions change over time. There have been forecasts with zero probability, which of course you can't have for some of those log scores, right? Now, this is the key table, and basically what it says is that simplex does the trick. And in some sense, I think, it's better than or as good as some of the other approaches, right? And so simplex combination works very, very well in this application here, as well as alternative approaches that require, tuning hyperparameters. It also works better than simple equal weighted average. So, and what you'll see is that it only includes 3.5 out of the potentially 19 forecasters. And so to me, at least, it would be interesting to show the time series of the optimi of the weights that you get. So is it the same 3 or 4 forecasters that repeat, or do they rotate? Maybe they shift, they take turns before and after the Great Recession. How different are these weights from the earlier Diebold Shin paper with this trim and shrink scheme that I mentioned also in the context of these earlier theoretical results. And so my final comment here is, in some sense, should we be surprised that simplex regularization does the tricks, excuse me? Well, there I think the paper really does a great job going with this insight that effectively the simplest constraint is like a special case of lasso, when you just put a big weight on the penalty term, right? And so you are, effectively, using a lot of regularization, and I think that's one of the reasons why it appears to work so well. And then, Frank also, discussed these interesting shifts over time towards the tails, and it particularly after the Great Recession. And I think, it would be interesting to sort of relate that to this literature, which is very active, Mankiw and Reich, Carroll, Bouchot, etc., that finds that there are these systematic biases and evidence of stickiness in survey and analyst forecasts. It's probably coming out here as well. All right, so just to conclude, it's a great paper suggesting that density combination methods that outperform equal weighting exist, and you can get at them if you use the simplex approach. This result is, startlingly different from the literature on combination of point forecast, which has been struggling to beat equal weighted averaging, but it's great. I always tell my students that, contrary to what you might think, I actually don't like the result that is so hard to beat an equal weighted average in point forecasting, because it means that there's limited scope for combination in that literature, right? But here it seems very different, so that's great. And I also think, a major advantage of Frank's approach is And with the simplest approach is that it requires no tuning of hyperparameters, and I think it's economically motivated if you think of it as a portfolio of density forecasts. Thank you.
Thanks a lot, Alan, for the excellent discussion. We don't have any questions, which is a good thing because we're running a bit short on time. So Frank, if you want to just take the remaining few minutes and respond to anything, that'd be great.
Oh, sure. Well, thanks so much, Alan. You were way too kind and made a lot of really good points. I can just respond very briefly to them. The last thing I want to do is exceed my time again. You know, your long discussion of what drives density weights was really great, I thought. We haven't thought about that at all. You know, what drives the optimal regularized mixture weights? And you had some nice theoretical results. I understand the sample size was 2 or 3 or something, but those were good insights. So I thought that was really interesting. On your question as to, like, could we see what forecasters are in at what time and who goes out at what time? Is it the same 4 forecasters or are they changing? They're definitely changing. And in fact, we have that graph. It's actually in the paper commented out or something, you know, in some appendix. We should probably put it back. But it is interesting to see, and it's definitely not the same guys. At the same time, you do get persistence in inclusion. You know, the who's in and who's out is definitely serially correlated. But as you go through the 20-year sample, you know, it's a very different group potentially who's in 2008 than was in 2002 or 2019. You know, so yeah, I'll just leave it at that. Thanks again.
All right, thanks, Frank. Thanks again, Alan. Thanks for everyone that presented and discussed in the session. So we'll take a 10-minute break now, and the last session will start up at 2:45 Eastern Time.
I'm Dachen Xu from the University of Chicago. We have 2 great papers this afternoon in the last session. We're going to start with Aditya. I'll let him to talk about high-frequency expectations.
Awesome. Thanks, Dachen. So hello, everyone. I'm very excited to have this opportunity to present some of our work here for you all today. So the paper is High Frequency Expectations from Asset Prices, a Machine Learning Approach. And this is joint work with my fellow PhD student from Booth, Sangmin, who's also here in the audience with us. So let's get started. So a lot of work, both in macro and finance, is trying to answer 2 questions. The first is, how do economic agents form their expectations? And the second is, when these agents update their expectations, what real effects does that induce? For example, when agents update their expectations about future GDP growth, about the future path of interest rates, how does that change their consumption decisions, their investment decisions, their portfolio allocations, things of that nature? And a common empirical tool in a lot of this literature is low-frequency surveys of macroeconomic expectations. So, for example, the monthly blue chip survey or the quarterly survey of professional forecasters. In particular, in the US context, we have the SPF run by the Philadelphia Fed, but like Frank was talking about, the ECB has their own equivalent as well. And the issue that a lot of this literature ends up running into is, how do you identify causal effects on expectations updates or causal effects of expectations updates at low frequency? So for example, say that you wanted to try to very precisely pin down what caused the decrease in expected GDP growth between March 1st and April 1st of 2020. In general, that's going to be a very difficult question to answer because, of course, a lot of different things happened in March of last year. And when many different events occur between survey dates, it's very difficult to pin down the precise causes of any specific expectations update. And the solution we're going to propose in this paper is that identification oftentimes becomes easier when you move to a higher frequency. So our goal here today is going to be to construct a daily measure of aggregate growth expectations. Why? Because this high frequency series is going to allow us to get clean identification and event studies. To that end, we're going to use reinforcement learning and asset prices. So we're going to start with a quarterly cross-section of real GDP growth expectations from the survey professional forecasters. And so we're going to observe a survey release like at the beginning of one quarter and at the beginning of the next quarter. Our task is going to be to recover the daily series of latent GDP growth expectations between those two quarterly survey release dates. And to do that, we're going to basically filter out growth expectations from asset prices. So why are we using asset prices? Well, first of all, they're available at high frequency. And second of all, they almost necessarily are going to reflect forward-looking expectations. And to solve this filtering problem of extracting forward-looking expectations from asset prices, we're going to use reinforcement learning. And as you'll see, RL is going to give us a very efficient means of solving this filtering problem. Once we have our daily series of expected GDP growth, we're going to use it to test the Fed information effect. The Fed information effect is this puzzle in the macro literature where hawkish monetary policy surprises appear to correspond to increases in surveyed real GDP growth. And this is weird. We usually think of, surprise rate hikes as being contractionary, but here they appear to correspond to, people increasing their forward-looking GDP growth expectations. So one interpretation of this phenomenon is that people view the surprise rate hike as a signal that the Fed actually has very bullish expectations for the economy. Because why else would they be making this rate hike when we did not expect them to? They must think that the economy can weather the higher interest rates. And so market participants use that hawkish monetary policy surprise as a signal to update their own private GDP growth expectations. That's the Fed information effect hypothesis. Now, the problem is that a lot of this literature is measuring real GDP growth expectations using low-frequency surveys. And you're going to have a clear omitted variable bias problem if you try to do that. In particular, say that you observe two surveyed real GDP growth expectations measures on either side of an FOMC announcement where the monetary policy shock occurs. Then any major economic news that occurs between the first survey date and the FOMC announcement could cause potential omitted variable bias. What we're going to do here is move to the daily frequency using our daily series of growth expectations. And we'll see that when we do that, we bypass this omitted variable bias problem, and we're able to get a much cleaner estimate of the effect of these monetary policy shocks on growth expectations. So our key findings are going to be twofold. First, we're going to find that reinforcement learning successfully filters growth expectations from asset prices. At low frequency, we're going to find that our daily series of growth expectations lines up very nicely with the actual observed quarterly series of growth expectations from the SPF. And we're going to see that outperforms some of the benchmarks in this literature. When we go to the high frequency validation, we're going to find that our daily series of growth expectations does actually experience large updates on big macroeconomic events. And that gives us some confidence that we're actually picking up something reasonable here. Once we have our daily series of growth expectations, we use it to test this Fed information effect. And we find that once you go to the high frequency and get past the omitted variable bias problem, we find no evidence of a Fed information effect. In our daily series, hawkish monetary policy surprises will correspond to decreases in real GDP growth expectations, which accords with our usual macro intuition. So our work here broadly relates to two strands of the existing literature. The first is the time series measurement of latent economic and financial variables. There's obviously a huge literature, and what we've shown you here is by no means an exhaustive list of methods or applications. But the thing I want to highlight is that what we're doing here is very similar in spirit. A lot of this literature is focused on, for example, measuring latent real GDP growth in real time. What we're doing here is only slightly different. We're trying to measure latent real GDP growth expectations in real time. The second literature is the application of machine learning methods to finance. So a lot of this literature is focused on applying machine learning methods to solve prediction problems. Today, we're going to show you how we use reinforcement learning to solve a filtering problem. So the way the rest of this presentation is going to work is I'll first present our empirical framework. I'll then talk about how well our RL approach filters out these growth expectations. And then I'll discuss our test of the Fed information effect before finally concluding. Okay, now let's dig in. So before diving into the empirical methodology, let me present the data we use to fix some ideas. For asset prices, we're going to use equities and fixed income. In particular, all the results I'll show you today will be using the CRISP evaluated market portfolio and the CRISP US Treasury 5-year fixed term index. For growth expectations, we're going to use the cross-sectional mean of the quarterly survey of professional forecasters. And in particular, we're going to focus on the 1 quarter ahead real GDP growth forecasts. And what that means is the survey that is conducted in the middle of Q3 2018 is going to report expectations for Q4 2018 growth. And based on the availability of this SPF data, the date range for our baseline analysis is going to be 1990 to 2018. So to begin the framework, we're going to start with a very simple asset pricing setup. As we usually assume in asset pricing, expected returns and dividend growth are going to be assumed to have a factor structure. The first factor is going to be latent GDP growth, which is this theta T, which we assume follows an AR1 process. And now we're going to assume that for all assets I, dividend growth depends linearly on GDP growth. We're also going to assume that conditional expected returns for any asset I depend linearly on some other latent factor, zeta T. And so you should think of zeta T as time varying risk aversion, macroeconomic uncertainty, time varying disaster risk, anything of that nature. But the point is, when you plug these processes for dividend growth and conditional expected returns into Campbell-Schiller, we're going to get that you can express log realized returns as being linear in current GDP growth, lagged GDP growth, and the current and lagged values of this latent factor, zeta T. The upshot here is that if you're someone who wants to estimate latent GDP growth from observed asset returns, then taking the appropriate linear combination of observed asset returns would actually recover latent GDP growth. And that's exactly what we're going to model these SPF forecasters as doing. We're going to assume that each of them is a Bayesian who wants to estimate this true underlying but unobserved GDP growth rate theta T, but they only observe the asset returns, which are these R's. And being Bayesians, they're going to use the Kalman filter to extract these estimates of latent GDP growth from asset returns. Now, the only subtlety here is that cross-sectional disagreement is an important feature of this survey data. And so we need to introduce ways to basically allow these agents to disagree with one another. And we're going to do that through 2 channels. We're going to allow these agents to disagree in their prior means over this quarter's GDP growth, expected GDP growth. And we're also going to allow them to disagree in the learning rules that they use to update their expectations about GDP growth based on observed asset returns. And the way we do that is say, okay, they're all using the same state space model when doing the Kalman filter, but they disagree about what the parameters in the Kalman filter are. So we can denote mu IT as agent I's conditional expectation about GDP growth at time t. And the Kalman filter implies this law of motion for mu IT. In particular, the Kalman filter implies that agent I's expectation for GDP growth at time t is going to be affine in the agent's lagged value, rather lagged expectation about GDP growth, and linear as well in today's observed asset returns. Now, we don't care about the expectations of any particular agent. We care about the cross-sectional mean across all agents. And what we find is that, fixed period t, and take the cross-sectional mean across all these agents I, denote that cross-sectional mean mu t. We find that you can approximate that cross-sectional mean growth expectation mu t as being linear in the lagged value of mu t, which is mu t minus 1, and in today's asset returns. So our task is going to be to estimate these coefficients, C1 and C2. That's going to give us a way to each day within a quarter between server release dates to update our previous estimate of the cross-sectional mean growth expectation based on observed asset returns. And now we're going to use reinforcement learning to estimate these coefficients, C1 and C2. And I think the easiest way to understand what reinforcement learning does is to compare it to a standard economic model. So take any standard macro model, we have usually some representative agent who has a utility function, and importantly, who understands the state transition dynamics of his environment. So for example, we have some agent with CRA utility over consumption, and he's making some consumption and investment choice each period. Where the standard approach would be to assume that he understands, the capital law of motion and the production function. So he knows how his choice of investment today affects his production and consumption possibilities next period. If you have this structure, then you can straight up derive the agent's optimal choices of consumption and investment each period as a function of the state variable, which is like the capital stock. The RL paradigm, on the other hand, assumes that the agent does not know the state transition dynamics of his environment. So for example, he might not know the depreciation parameter, so he doesn't know what the capital law of motion is. Or maybe he doesn't know the production function, so he doesn't understand how his investment affects his production and consumption possibilities for next period. In reinforcement learning, we assume that the agent doesn't know how the environment works, so we can't simply derive what his optimal action, also known as optimal policy, are. Instead, the reinforcement learning agent is going to have to try a different bunch of things, see what works and what doesn't work, and from that, bootstrap an idea of what the right thing to do is. And so he's going to basically have to learn the optimal action through lived experience. So to be a little bit more concrete, all reinforcement learning applications are going to have three components: an agent, an action, and an objective. So in our setting here, we are the agent. We are this outside econometrician who is seeking to learn how to update our estimate of the latent cross-sectional mean of GDP growth expectations throughout a quarter based on observed asset returns. So to be very concrete, focus on the timeline at the bottom of the screen. We observe the SPF quarter release at time 0, and we observe the cross-sectional mean in that survey. We know that at time capital T, we're going to observe another SPF release and another cross-sectional mean. Within the quarter, though, we're blind to what agents' expectations are. And so we want to know what's the optimal way, the optimal policy to update our cross-sectional mean from this time 0 each day throughout the quarter based on observed asset returns until we get to time capital T and we see the next cross-sectional mean. That is to say that we want to know this optimal policy G, which is going to tell us what the optimal action in each period is. Okay. And what's our objective here? Basically, when we arrive at the end of this quarter and we see the next SPF cross-sectional mean in the data, we want our estimate of the cross-sectional mean at that time, which is like mu hat subscript capital T, to be as close as possible in a Euclidean sense to the true observed cross-sectional mean, like mu no hat subscript capital T on that day. So the upshot here is that we seek to learn this optimal linear learning rule G that's going to tell us how to update our estimate of the cross-sectional mean growth expectation based on observed asset returns. And to do that, we're going to use a variant of the COP-DAQ reinforcement learning algorithm from Silver 2014. And we're going to compare the performance of our reinforcement learning approach to some standard benchmarks. And in the interest of time, I'm not going to go into too much of how these benchmarks work. But in brief, first, we're going to have a naive benchmark that models the cross-sectional mean as just a normal random walk. So like you observe the cross-sectional mean at the start of the quarter, assume it doesn't change within the quarter until you get to the next SPF release. We're also going to use a Kalman filter. So we're going to set up a Kalman filter to solve the same filtering problem of extracting these cross-sectional means from observed asset returns. This is the same filtering problem that the reinforcement learning algorithm solves. The only difference here is that the Kalman filter needs to estimate the entire underlying state space model, which is, in this case, going to involve a lot of different parameters, in particular 3m plus 11 parameters, where m is the number of assets that we use. Okay. The third thing we're going to do is we're going to use Midas regressions as well. Now, this is very much in the style of Geisel's in RAID 2009. For each day within the quarter, we're going to fit a Midas regression to forecast the next SPF cross-sectional mean that we'll observe at the next server release date. But since we're using a different Midas regression for each day within the quarter, this process is also going to involve estimation of a very large number of parameters. In particular, it's going to be m plus 4 parameters, m being the number of assets, for each of the capital T days within the quarter. So why do we think, a priori, that our reinforcement learning approach will be able to outperform these benchmarks? Well, first of all, obviously, it's going to be much more flexible than the naive approach, but it's also going to be much more efficient than these benchmark methods. In particular, we're going to be estimating far fewer parameters, only m+1 parameters in this optimal linear policy function G. And so we know fewer parameters that we need to estimate is going to enable much more efficient estimation of this cross-sectional mean mu-t. Let's now assess the empirical performance of each of these methods. So we do a recursive out-of-sample estimation, whereby we basically fit each of these four models on n quarters, and then apply the fitted model to each day in one out-of-sample quarter. And we're also doing some model averaging over look-back windows of different nets. But at the end of the day, we're going to recover an estimated daily series of growth expectations corresponding to each of these four methods. And what this table is showing you is the low-frequency comparison between each of those daily series and the true observed SPF cross-sectional mean series. And in the first column here, we can see that the daily series corresponding to our reinforcement learning estimation lines up very well at low frequency with the actual observed SPF cross-sectional mean series. I mean, the R-squared is over 82%, so we're doing quite well in absolute terms, but it's also much higher than the benchmark methods. And now we can see this good low frequency fit visually as well. In blue here, we're plotting our daily estimated cross-sectional mean via the reinforcement learning estimation. And we've overlaid in red the SPF cross-sectional mean true observed series. And you can see that at low frequency, they line up like decently nicely. But that's just a low frequency comparison. How do we know that our series is like giving us meaningful high frequency variation between server release dates? To do some type of high frequency validation, we look at the 10 largest daily updates to our estimated series of growth expectations in absolute value. And that's what we're showing you in this table here. And now we ask the question, on those days with large expectations updates, were there also big macroeconomic events that we think ought to have induced agents to have updated their expectations by so much? And the answer is yes. A lot of these major expectations updates days correspond to either major developments in the financial crisis, late 2008, early 2009, or to dates in the late summer of 2011, when we also had a lot of macro volatility, in part due to political issues in the US involving the raising of the debt ceiling. So having established that our reinforcement learning approach estimates a meaningful like daily series of growth expectations, let's now use it to test the Fed information effect. What we have here is the usual Fed information effect regression. And what this literature usually does is use low frequency surveys to measure real GDP growth expectations. So for example, Nakamura and Steins in 2018 are using monthly blue chip forecasts of real GDP growth. So on the left-hand side, we have that monthly update to real GDP growth expectations measured at low frequency. On the right-hand side, we have the monetary policy shock that occurs on the monetary policy event at time t. So this regression is trying to, tell us, how do agents update their expectations about GDP growth due to this monetary policy shock? And most of this literature finds that the estimated beta 1 in this regression is positive, which means that agents see a hawkish monetary policy surprise and raise their GDP growth expectations going forward. The problem is that we have an omitted variable bias here. Now, focusing on the timeline at the bottom of the screen, any major economic news that occurs between the first server release date and the actual monetary policy event could potentially cause omitted variable bias. In particular, if this omitted economic news is positively correlated with the monthly revision in GDP growth expectations, and is also positively correlated with the time t monetary policy shock, then you're going to have positive omitted variable bias on your estimated beta 1. And Bauer and Swanson have a recent paper where they verify both these positive correlations using non-farm payroll news. Here we're going to sidestep this omitted variable bias problem by moving to the higher frequency. Our daily series of growth expectations at time t-1 walking into the FOMC announcement will already have incorporated all of this previously omitted economic news, which means that when we regress the daily change in GDP growth expectations on the time t monetary policy shock, we're going to get a much cleaner estimate of this beta 1, which again is how people revise their expectations due to the monetary policy shock. And to measure these monetary policy shocks, we're going to use the same shock series from Nakamura and Steins in 2018, which is basically the first PC of high frequency changes in 5 different interest rate instruments. So we're going to run this regression, and we find a significantly negative beta 1 estimate. And that's what I've highlighted here for you in yellow. You should interpret this magnitude as a monetary policy shock large enough to raise the 1-year treasury yield by 100 basis points, lowers 1 quarter ahead GDP growth expectations by 83 basis points. And now you should contrast that with the significantly positive estimate that Nakamura and Steins in 2018 find. So again, our negative coefficient estimate here implies that hawkish monetary policy surprises are viewed as contractionary. And I mean, the implication here is that we find no evidence of a Fed information effect. People here appear to be responding exactly as our traditional macro models would suggest. They see a surprise rate hike, and they view that as contractionary going forward. So to conclude, we use reinforcement learning and asset prices to construct a daily series of real GDP growth expectations. And our hope is that our approach here and these types of high frequency series of macroeconomic expectations can help empirical researchers advance our understanding of expectations formation. Because now we can really dig in a high frequency, precisely identify what causes these expectations to change over time. And as one example of how we think our methodology here can be useful, we use our high frequency series of real GDP growth expectations to test that Fed information effect. And we find that when you move to the high frequency and get past the summated variable bias problem that the previous literature has encountered at low frequency, we find that there's no evidence of a Fed information effect. So that's all I have for you today, and I look forward to your thoughtful feedback.
Thank you very much for a great presentation. And it's our pleasure to have Jonathan Wright to discuss this paper. Jonathan, go ahead, please.
You can see my slides?
Yes.
Okay, so thank you very much for inviting me to discuss this, this very interesting paper. So this paper is about interpolating survey expectations between survey dates using asset prices. And 3 approaches are compared. One is the Kalman filter. In my book, what the Kalman filter means is you've got a latent state, which is people's expectations following something like an AR1. And then the asset returns on day tau, so tau here refers to a day, will load on the change in those beliefs. I think that this paper has a somewhat different definition of the Kalman filter, and this is something I want to get back to. A second method is the Midas method, where we've got the survey expectation for quarter T, which we regress on the previous survey expectation and a distributed lag of daily asset returns. And you're going to have a different set of parameters for every day within the quarter. And so the parameters are subscripted by tau for days. And then the third is reinforcement learning. So I'll characterize reinforcement learning. I think it's exactly the same thing as in the paper, but I'm just going to characterize it a little differently. I've got a mu0, which is an old SPF forecast, and a mu-t, which is a new one. And the days are the times between the old and the new one. And I'm going to have a rule that my belief on day t plus 1 is a linear function of my belief on day t and the returns on day t. And the way I'm going to get the coefficients on that in that equation is to find the choice of lambda, which minimizes the distance between what the actual survey turns out to be and what was predicted the previous day. So if you then substitute backwards, What this amounts to is that my beliefs about the survey on day T, conditional on the previous day, is a particular distributed lag. And so when I am picking the lambda to minimize this Euclidean distance, it's really a particular functional form relating expectations, SPF expectations, to the lag of expectations and the daily asset returns. The paper makes a point that Midas is estimating the expectation of the stated capital T, conditional on the information set at little t, whereas the Coleman filter and reinforcement learning are both estimating the expectation of mu at date little t. This cap t and little t thing is tricky. So today is March the 5th, and the next SPF, let's say, is May the 5th. So what we mean by mu t is the forecast, the SPF forecast of, let's say, Q3 GDP that will be released on the 5th of May. Mu little t is not what we are predicting that's going to be today. That would be today's expectation of mu capital T. What mu little t really is what the forecast would be if we were to shift the timing. If we were to, instead of imagining forecasting Q3 GDP, we were to ask the respondents today to forecast growth for a fictitious quarter consisting of April, May, and June, which is fair enough, but that seems a kind of weird concept. A second selling point is that reinforcement learning has fewer parameters, and that's true. But it's in a certain way kind of overcounting the parameters in Midas, because yes, Midas has 60 times m plus 4 parameters, but the parameter for 11 days into the quarter and 12 days into the quarter are almost identical, as they should be. But nonetheless, the point is well taken that reinforcement learning is parsimonious. There's now a literature on the Fed information effect, where surprise easing of monetary policy has the wrong sign in the effect on growth and inflation forecasts. And in this paper, using their daily expectation series, they're able to come to the conclusion that there really isn't any Fed information effect. They're using the same argument as Boyuan and Swanson, who are saying that the Fed and the blue chip are both reacting to data that came out before the meeting. Having worked at the Fed, I like this result. I find it extremely implausible that the Fed has all of this incredible secret information, and that when they release their monetary policy decision, they've let the cat out of the bag, which is what the Fed information story is. So I'm mystified by what this amazing information is. One question I have, maybe more for Bauer and Swanson than for the authors, is if it's really true that there's information that blue chip is reacting to before the meeting, then you could use that information to predict the monetary policy surprise. So the monetary policy surprise is meant to be measured from Fed funds futures markets. So the story has to be that the Fed funds futures market wasn't in on the joke. And that mystifies me. That's not really a comment on this paper so much as on this general premise. Okay, so here from the paper is the estimated daily series in blue and the quarterly SPF 1 quarter ahead growth forecasts in red. I think it might be a little clearer not to join the dots, because the point is that the SPF just comes out once a quarter, but you see that you do a good job of predicting where the next one is going to be. And in the paper, it also shows the corresponding picture for Midas, where you certainly see where Midas is going wrong, because it's jumping all over the place. That puzzles me though a little bit, because Midas, when Eric and I worked on it, it seemed to be giving us pretty distributed lags over about 90 days of data that were quite smooth. And so I'm a little puzzled at how these forecasts are so jumpy. Maybe it's particular to 1 quarter ahead GDP over this period, I don't know. And more puzzling again is what we get for what the authors show for the Coleman filter, which is where every time a new SPF comes out, the Coleman filter immediately starts saying, oh, the next time it's going to be 20% or 40% or 100% GDP growth. So the Coleman filter is giving crazy results. So I'm very surprised by the results, especially for the Coleman filter. At least with my definition of the Coleman filter, Eric and I did exactly that picture in our paper, and it looks very different. I mean, the Coleman filter is nothing great. It's got a restrictive specification, lots of things you can say bad about it, but it's not just completely crazy. So I wonder if it's something to do with the precise way the Coleman filter is set up. And of course, that then tells us when we go and look at tables of root mean square errors, the reinforcement learning approach is doing well relative to naive. That's fine, that makes sense. I'm a little surprised that Midas here is doing less well, but you know, the 39 percentage point root mean square error is just the point at which I say no. This is something else. It's not giving the Coleman filter a fair shake. That's my only real comment on the paper. Two other quick points I will make is the timing of the surveys for all of them, whether it's blue chip or SPF, is such that the respondents have to turn in their prediction about a week before the release. So returns that come out after the survey deadline shouldn't really be relevant. I would treat date capital T not as the date the thing is published, but as the date that they turn in their forecasts. And another point that occurred to me is the exercise that the authors are doing here and that Eric and I did is about interpolating between H quarter ahead forecasts last quarter and H quarter ahead forecasts this quarter. That's fine, but that means that you're predicting a different object each time. You're interpolating between the forecast of Q2 GDP and Q3 GDP. So it gets me wondering why we don't instead try to interpolate between the H+1 quarter ahead forecast last quarter and the H quarter ahead forecast this quarter, so that you're always predicting the same thing. And maybe that would allow for a somewhat tighter parameterization. So it's a very nice approach to filling in survey expectations to interpolate them at a higher frequency. The competitors are faring miserably, and I'm a little puzzled by that. And the paper finds convincing evidence that there's no Fed information effect, which is a very nice usage of daily survey expectations. So thanks again.
All right. Thanks, Jonathan, for the very insightful discussion. And I will give time to Aditya and Sangmin to respond.
Yeah, so first of all, we just want to thank Jonathan for the terrific discussion. I think there's a very clear synthesis of a lot of points we make in our paper, and there's a lot of really great feedback in there. So thank you for that. I guess just to start off, I guess the first point is the Coleman filter, which we find does perform quite poorly. So the Coleman filter setup that Jonathan had on his slides is one way of setting up the Coleman filter in this setting, where asset returns, observed asset returns, are dependent on the latent change in expectations. So that's not the way we set it up. And I think it's fair to say that we should try Jonathan's alternative approach. And that might actually, it wasn't immediately obvious to us that that was the most natural way to set it up in this setting, but I think it's fair to say that we should try that as well. The way we set the Coleman filter is you have basically these latent expectations for each individual at the quarter that you observe quarterly, but that you don't observe in the quarter. The cross-sectional mean across all those individuals is also not observed. But the way we're setting up the Kalman filter is actually kind of the opposite of what Jonathan had the slides. It's not that returns depend on the expectations updates structurally. It's that the expectations updates actually depend on the returns. That these the paradigm we're taking is that these forecasters are not market participants, but they exist kind of on the side, and that they observe these asset returns, and from those asset returns, they like extract signals to update their own expectations. And the particular way in which we model the Kalman filter, like I think is very reasonable to think that might be leading to the poor performance of the Kalman filter here. And we take the point very well, and we'll look into that and try alternative methods that might be giving the Kalman filter a fair shake at the data. So I think that's absolutely fair. That was the main point. Other than that, I guess a couple of more minor points. I think the timing point is also well taken. And I have to say, a priori, I don't think it should make a gigantic difference, but we could try that for robustness, absolutely. The lag point is something that we had thought about. Like today, like each quarter, should we predict a fixed horizon? Should we like be measuring expectations for a fixed horizon ahead? Or should we be like fix the quarter ahead? Or yeah, basically, should we fix the quarter or should we fix the horizon? And we came to the conclusion that like, you know, if like time varying weights have some like exponential decay structure or something, then like fixing the quarter ahead might, which is something you could do with our approach, would be slightly different than fixing the forecasting horizon essentially. So that's why we chose that specification. But also, again, the point is very well taken. We could try other things as well, for sure.
All right, thanks a lot. Sangmin, do you want to add something?
No, I generally agree, and we appreciate your comment about the Fed information effect, because that's been something that we've been discussing internally as well. And it's just good to have a confirmation from somebody who actually worked at the Fed. So appreciate that comment as well. Thank you.
Great. So we still have some time for a question from audience. In fact, Eric might have a question, or?
Yeah, I want to perhaps make a little bit of a number of comments that built on what Jonathan actually said. The first thing is I also find the results of the Kalman filter not really, or incredible in a sense that, and in particular in the context of the fact that Jonathan and I have another paper with Jenny Bai, where we show a mapping between the Kalman filter and a Midas regression. Now that is sort of an exact mapping in a certain setting, which I think is very similar to the setting that Jonathan set up, or it is an approximate mapping, and it's a very good approximate mapping, either in terms of the weights, sort of an L2 measure of the weights, or in terms of a forecast distance measure. And so it would be very surprising to find such big differences between Midas regressions and the Kalman filter in light of the results in that paper, actually. And the second comment is, in some sense, you actually have a Midas panel regression problem. And therefore, you sort of could take advantage of the panel structure and combine that with the machine learning sort of machine learning Midas extensions, or extensions of Midas with machine learning. There is a paper that Andre and Jonas and I have on panel regressions with Midas, and that would vastly, because you have a scope for pooling, that would vastly reduce the parameter space. And sort of bring in cross-sectional smoothing, as opposed to, in addition to the time series one, which Jonathan alluded to, by the fact that these coefficients shouldn't move very much from day to day. So anyway, these are just suggestions. I enjoyed your paper. Thanks.
And thank you so much, Eric. Again, all points are very well taken, and yeah, I think for sure we'll be looking into these alternative methods and alternative approaches you've just present to us, definitely.
All right, thanks a lot. So I see Sangmin is responding to a question, is responding to a question in the Q&A. So in the interest of time, let's take a break for 5 minutes and waiting for the last paper. Thank you. All right, welcome back, everyone. Let's resume the last session. So the last paper is going to be presented by Andrew on high-dimensional Granger causality tests.
Thank you very much to organizers for this excellent opportunity. I will discuss high-dimensional Granger causality tests with an application to VIX in news. This is a joint work with Eric and Jonas Chiaukas, who is a PhD student at Université Catholique de Louvain. So in this paper, we want to test Granger causality. And when we talk about Granger causality, the main issue is that this is not a structural notion of causality. This is a statistical notion of causality. On the other hand, the statistical view of causality has been extremely influential in microeconometrics over the last 20 years. And the main argument that we have in the potential outcomes framework is that if you control for a sufficiently rich set of confounding factors in the regression case, we can get closer to estimating the causal effects. And so in this paper, we look at high-dimensional Granger causality tests, where we can have a high-dimensional set of controls, and we will use the sparse group lasso regularization in order to address this problem. And I will explain in a couple of slides why do we look specifically at the sparse group lasso regularization. So the Granger causality test is just an example of inference in high-dimensional time series regressions. And more generally, when we want to have valid Hug-based post-model selection inference. And so our paper also addresses this more general problem. And the empirical example that we have in mind is to test the Granger causal relationship between the VIX and financial news. So we want to know, for example, what news topics published in the Wall Street Journal Granger caused the market-based expectations of volatility, that is the VIX. So our paper connects to 3 strands of the literature, and we have more comprehensive literature review in the paper. We have lots of papers on the lasso. So we look at the sparse group lasso, and we cover lasso as a special case. There is a literature on Granger causality and Granger causality testing. And there is also an older literature on Hug-based time series inference that is mostly focused on the low-dimensional case with parametric convergence rates. So our contribution is to introduce new methodology, structured high-dimensional Granger causality tests based on the sparse group lasso regularization. In order to prove theoretical results, we need to introduce new Fuchs-Nagaev concentration inequality that applies to heavy-tailed tau mixing processes. And the results that we have in this paper are the debiased central limit theorem for time series data and sparse group lasso with explicit bias correction. And we also established the validity of the Hug-based inference where we use sparse group lasso residuals. And in the empirical application, we find that the topic of the financial crisis, Granger causes the VIX, and we don't have the reverse causality. So this paper also relates to the other 2 papers that we have out there. These 2 papers, they are mostly focused on prediction problems and nowcasting with individual time series regressions and high-dimensional final data regressions. So today I will only discuss the inference. So this is the plan for the talk. I will talk about Granger causality, sparse group lasso regularization, and then I will introduce new concentration inequality. Then I will discuss the biased central limit theorem and Hug-based inference. And in the last part of the talk, I will discuss VIX and financial news and Granger causality there. So Granger causality. If you go back to the original 1969 Granger's paper, he had the following notion of causality in mind. So we say that the series ZT does not cause another series YT if the projection of the series YT, so YT plus 1, on all the information that we have in the universe available at time t. These projections do not change if we remove the series ZT from the information set. So this is the definition of the Granger causality in terms of the least squares projections. More generally, we can also consider the Granger causality in terms of conditional expectations or even entire conditional distributions. So in words, this definition of the Granger causality tells us about the marginal improvements in projections due to the series ZT. And so even in 1969, this was a high-dimensional problem because all the information available in the universe at time t can be a pretty large set. So typically in practice, we consider the following testable implication of the Granger causality. So we regress YT plus 1 on the series ZT and its past lags, and we have some controls denoted WT here. And so the set of controls represents an approximation to all the information available at time t, and it can be high dimensional. And then the Granger causality tests amounts to checking whether the vector of slope coefficients for the series ZT and its lags is equal to 0 or not. So now I will consider slightly more general setting. It covers the Granger causality test as a special case. So more generally, we have a linear projection model with potentially countably infinite number of predictors. So these predictors X, T, J here can include lags of Y. It can be some other generic predictors with lags and many other types of predictors. And so we want to test a hypothesis that a low-dimensional group of regression coefficients denoted beta G, where G is a subset of indices. We want to test that this beta G is equal to 0 versus that this is not the case. So next, I want to argue that in the high-dimensional time series setting, we often have sparse group structures, and it can be important to take these structures into account. So we find in our other works that when it comes to prediction in Monte Carlo simulations and in the empirical application, using sparse group structures can improve prediction results, and it can also improve the estimation results as well when we do have such structures. So the first example of sparse group structures comes in our empirical application, where we look at news series extracted from Wall Street Journal articles. And these news series can be grouped by topics. So we want to select topics, what topics are important for weeks. And within a given topic, we can have a large number of series. So we want to do this model selection at two levels. We want to select topics and we want to select individual series within a given topic. The second example is a little bit more complicated, but well, here is the idea. So we may treat lags of a single covariate as a group. And then selecting a covariate with its lags amounts to selecting the group. And we can think of including a large number of lags, like was presented in the previous talk. And so these slope coefficients, beta j, can be high dimensional. And in this case, we may want to do some additional dimensionality reductions. For example, you can parameterize these slope coefficients beta j by some Midas weight function omega j. And we're going to approximate this function omega j using some dictionary of approximating functions, for example, Legendre polynomials, or it can be something else. And so here we get sparsity, at least in the approximate sense, because it is reasonable to believe that it is enough to have several basis functions in order to capture most of the nonlinearities of this lag polynomial. So we argue in favor of this structure sparsity approach, and we want to do the model selection at two levels. So this is a hierarchical model selection problem. We want to select groups, and then we want to select within groups. And it turns out that the sparse group lasso regularization allows us to do that. So let me introduce the sparse group lasso regularization. The sparse group lasso regularization is the following one. So we will solve the penalized least squares problem. This is the first part is just the usual least squares objective function. And we have a penalty term omega, where omega is a linear combination of the lasso penalty. So this is the lasso L1 norm and the group lasso penalty. The group lasso penalty can select groups, and this is denoted by 2-1 norm. And so we have this weight parameter gamma. If gamma is 1, then we get lasso as a special case. If gamma is 0, then we get the group lasso as a special case. And gamma between 0 and 1 will combine lasso and group lasso, so it will allow us to do this model selection at 2 levels. And we have the regularization parameter lambda. So in practice, we want to learn from the data what is the optimal amount of the regularization lambda and what is the optimal combination of the lasso and the group lasso penalties. This is an example of the convex optimization problem. So it is extremely easy to solve it in practice. In practice, we would use some sort of gradient descent algorithm. So we have to compute the gradient of the least squares objective function. And at each gradient step, we have to apply a certain proximal map that is there because of the regularization. So in order to prove some theoretical results for this estimator, we get a new concentration inequality. So first of all, it is worth mentioning that when we talk about the linear projection model with autoregressive lags, then we get processes that are not alpha mixing processes that we typically use in econometrics. But we get processes that are tau mixing processes. So in order to describe the tau mixing process, we need to introduce the tau mixing coefficient. So for a stationary real valued process, xit with history ft, the tau mixing coefficient is defined as follows. So we're going to measure how much dependence we have between the future and the past when the future and the past are separated by KLX. And we measure the amount of dependence between the future and the past using this tau coefficient. So it's a similar idea to mixing coefficients, to alpha mixing coefficients. The main difference is how we measure the distance or the deviation from the independence between the future and the past of the process. And this notion of tau mixing is very convenient because it turns out that when we approximate dependent processes by independent blocks, the approximation error or the coupling error is exactly equal to this tau mixing coefficient due to the Decker-Prior coupling. So then we call the process tau mixing if the tau mixing coefficient decreases to 0 once we separate the future and the past by KLX. And it can be shown that the tau mixing coefficient can be sandwiched between the mixing Gale coefficient, denoted gamma k, and the alpha mixing coefficient, denoted alpha k. So tau mixing processes is a more general class than the alpha mixing processes. We cover alpha mixing processes as a special case. So this is the main theoretical result of the paper. If you look at a centered real value stochastic process in RP, such that each coordinate of this process has a finite moment of order 2 plus epsilon. So this is an extremely weak requirement for tails. And if you assume that the tau mixing coefficients decline polynomially fast, then we can get a bound on the maximum of the high dimensional mean. So we can bound the tail probability for the maximum of the high dimensional mean. And in this bound, we get 2 terms. So we have a polynomial term and we have an exponential term. And to get some intuition, typically when we have a sufficiently large sample, the data becomes closer to Gaussian. So the sample mean becomes closer to Gaussian. So this term is like the CLT term. But in finite samples, we may have deviations from Gaussianity because we have heavy tails. So the data are not Gaussian in finite samples. And this first tail describes this polynomial nature of the data. In the polynomial tail, we have an exponent kappa, and this kappa measures how much persistence and how heavy tails we have in the data. So next, we will apply this inequality to prove the Debye central limit theorem for the lasso, and we will obtain a valid Huang-based inference. So there exist several ways to do inference for the lasso. I particularly like the debiasing approach based on the explicit bias correction because it is very easy and simple to explain and to understand. So intuitively, the lasso is a biased estimator. We introduce bias with the regularization. And so if you add some bias correction term, then we eliminate this bias and we can get the parametric convergence rate for a low dimensional group of regression coefficients. So we get the usual central limit theorem. And here we have the following requirement: how fast the number of covariates that we put in the model can grow with the sample size. So in principle, we can handle P being much larger than T, depending on how heavy tails and how persistent the data are. We can handle P much larger than T or just a little bit larger than T. And we also have this long ground variance here. So we have to estimate it using the Huang estimation approach, for example. And an immediate application of this, if you know how to estimate long ground variance, is to do the Diebold test or the Granger causality test. So how do we estimate the long ground variance? We will use the usual Huang estimator. The only question is to show that it actually works in practice and what drives its performance in practice. So we have the following result for the Huang estimator. And here MT denotes the lag truncation or bandwidth parameter for the Huang estimator. P is the dimension of the model. So this is the dimension of all parameters that we are estimating with the sparse group lasso. And we have this exponent kappa that reflects the dependence on tails and the persistence of the data. And so from this result, we can see that the optimal choice of the bandwidth or the lag truncation parameter should scale with the dimension of the model P and also with the persistence and tails. So in the parametric framework, we typically know that the Huang estimator does not work great if we have persistent data, but we don't see it from the theory. And interestingly here, for the high dimensional regressions, we can see that persistence and tails can be important. So of course, these are convergence rates, and the question is maybe we can do a bit better than that. And so I want to argue that we cannot get rid of these dependence in the convergence rate of the Huang estimator. And the intuition for that is that in order to estimate the long ground variance, we need to be able to estimate regression errors in a good way. And so we have to estimate accurately the entire high dimensional part. There is no way we can just debias or partial out this high dimensional part from the regression equation if you want to estimate consistently regression errors. So the main takeaway from this result is that the usual rule of thumbs that we use for Huang-based inference do not apply. But at this stage, we don't offer a good rule, so we probably need to write another paper on this. And in the last part of the talk, I will discuss testing Granger causality for weeks with financial news. So we have the following two questions. First, which news topics from the Wall Street Journal Granger caused the future weeks? So what are the topics that Granger caused the market-based expectations of future volatility? And are news topics Granger caused by the weeks? So do we have this reverse Granger causality? So we consider our structured sparse group lasso regressions. The dependent variable is the monthly observation of the weeks. And we use daily weeks lags. So these are 22 lags. So it's a large number of lags. And we're going to aggregate these lags using the Zhang polynomials. So this creates this sparse group structure. And here we also have 180 new series extracted from the paper by Bakalli Manela and Xu. So I'm sorry if I pronounce some names incorrectly. So what they do, they extract, they run the topic model on the news, Wall Street Journal news articles, and they extract different news time series. And so we can see at what point of time which news is picking up more attention, and we can try to see which news Granger caused the weeks. So these are the results. We look at the 1% volt test for Granger causality and at the 5% level volt test for Granger causality. And these are p-values. So we plot, we report results on the grid of lag truncation parameters from 20 to 60. And we consider two kernel functions for the Hug estimator, Parson and quadratic spectral. So the results are pretty robust. And we can see that the daily weeks lags seems to Granger cause weeks at 1% level test. And the financial crisis news is also Granger causing the weeks. At 5% level test, we also pick up recession and aerospace defense topic. Next, we do the reverse Granger causality. So we regress the financial crisis news series on weeks lags and on other news series. And we can see that at 5% level test, it seems that most likely we don't have this reverse Granger causality. So to conclude, in this paper, we introduced the biased inference for structured high-dimensional time series regressions based on the explicit bias correction. So it is very simple to explain and to understand. We study valid Hug estimation based on the sparse group lasso residuals. And we show that machine learning methods may be useful for Granger causality, even if you have more series than the sample size. Our theory shows that you can handle heavy tail dependent data, but how well we handle heavy tail dependent data depends on how heavy tail these data are and how persistent the data are. And we find that the financial crisis news topic seems to Granger cause weeks. And we also have a Midas ML package on CRAN that currently does not support inference, but it supports some of the regressions that I presented here. Thank you.
All right. Thanks, Andrew, for a nice paper and a nice presentation. The discussant is Marcus Pegler. Please go ahead.
Hello. Thank you very much for the opportunity to discuss this paper. Can you see my screen?
Yes.
Okay, perfect. So this is a really nice paper. So the question is how to test for Granger causality in a high-dimensional time series setting. And this paper proposes to use sparse group lasso regularization. And the main contribution is to develop a general inferential theory for this sparse group lasso setup. So in particular, they develop HAC, heteroscedasticity and autocorrelation consistent estimators for the long-run variance. They propose a de-bias central limit theorem. And importantly, these results are going to hold for persistent time series data that can have heavy tails. There's a technical contribution that is used as a tool to derive these results, and that is a novel Fuchs-Nagev inequality for processes with heavy polynomial tails. And as a result, or as an econometric finding, they show that the estimators will depend in a complex way on a number of different rates that depend on the sample size, the dependency, and the tail behavior. There's a nice empirical application where they study the Granger causal relationship between wicks and financial news. And I want to emphasize this is an interesting paper, very general results, and is also very topical, and I highly recommend to read it. So let me quickly summarize the model. So it starts with a very plain vanilla regression type framework where we want to explain why, given a large number of covariates X, but we assume that the coefficients that we have in B are in some form sparse. So we use a lasso regression where we now have a so-called sparse group lasso. That means we have sparsity in the typical lasso sense, but we can also have sparse in terms of a small number of groups, where each group has a finite number of elements. Now, the groups have to be specified by the econometrician. So there are some obvious examples. For example, in the time series context, you can define all legs for a specific variable as one group. In the application, when they use text data, they use topic groups to put news that are in the same topic into the same group. I mean, obviously, defining the group will have an impact on the results, and that might be a question of how to do it in a specific empirical application. So the asymptotics are developed in a setup where the number of time series observations T and the number of covariates P is large. But the assumption is that the population model is sparse. Now, I just want to highlight the main findings again. So there's a technical finding, which is this Fuchs-Nageev inequality result. And what it shows is that if you have a process with heavy tails and a certain form of persistence, there's a bound, a polynomial and exponential bound on the tails of the high dimensional means. So this is a sharp bound and is of independent interest that goes beyond the findings of this paper and can be used as a tool for follow-up work in this literature. Now, I think the main result is this D-bias central limits theorem. So we have seen it before. So what it says is that the estimated coefficients follow normal distribution after you correct for a bias. And this bias correction follows the intuition or the arguments of the paper by Van der Waart 2014, Annals of Statistics, based on an inverse precision matrix estimation. And the hard part of this paper, I think, is to correct for the bias and to estimate this Huang covariance matrix. I think that is the main contribution. For the empirics, this was very well explained before, is a Granger causality test between VIX and 180 news attention series taken from another paper. It's based on monthly data, and the results show the effect of different bandwidths and kernel choices for this Huang estimator. The lasso tuning parameters are selected via cross-validation, and the empirical finding is that financial news can Granger cause VIX, but not the other way around. And the group lasso indicates that a group that can be called bank is significantly Granger causing the VIX. There's an interesting application with findings that make sense economically. Now let me come to the comment part, and I would like to ask you to view my comments as constructive. So first, I think the paper would benefit from better relating the existing literature to the contributions that they have. So there is actually quite extensive literature to test for Granger causality in a high dimensional setup. So first, it depends on where you assume the low dimensionalities in your model. So that means where do you assume sparsity? There are papers using canonical correlation, factor models, PCA, or Bayesian models. Now, the idea of using a group lasso for Granger causality test is also not new. There are papers by Nicholson that use a hierarchical group lasso, or Skipknopf, Michaelidis that use a generalized sparse fused lasso, but those papers don't have an inferential theory. However, there are papers that also have a group lasso setup and provide an inferential theory. One paper would be the work by Wilms, and these guys use a bootstrap, but their inferential theory is not correct because they ignore the post-selection issue that you have when you use lasso. That's an important point I want to talk about later. There is work by Heck et al., and they extend the work of Belloni, Chernouzukov, and co-authors that provide a solution to this post-selection issue. There's also work by Song Taomoti that use factor models to also provide correct inferential theory in a large dimensional setup. Another interesting work that could be mentioned in this paper would be machine learning solutions. Tang and Calvo and Pardo and co-authors use also group lassos, but combine them with deep neural networks to test for Granger causality. So I'm mentioning all of this to make it clear that I view the main contribution of this paper to provide this Huang estimator, and in the context of heavy tails and persistent data. Other ideas have already been out there in the literature. Now, one thing that is very important when we talk about inferential theory in a lasso setup is a post-selection inference. This is a very hot topic in statistics, and this post-selection issue has already been pointed out by Lieb and Pötzner in 2005. Roughly speaking, what it means is if you select your model on the same data where you want to do inference, you cannot use the standard inference tools, but you need to correct for the selection. In the context of lasso, it means if you are selecting a sparse set of variables and then do a naive, for example, regression inferential theory, it would be wrong. Now, this paper, I think, is taking this post-selection issue into account by doing this debiasing, building on the work of Van de Gaart, 2014. But I think the paper would benefit by explicitly explaining why they are doing certain steps. So there's no discussion about this post-selection inference in the paper, so they could point out they are doing debiasing to address exactly this problem. Another point I want to emphasize has to do with the sparsity. This is less about the theory, but more when you want to use this tool as an applied researcher. So where is the sparsity in the data? In some cases, we know we have dependent data, but when we rotate the data, for example, in the principal component space, we have a sparse set of covariates. Now, in the empirical data, it seems to me that these explanatory variables are actually strongly correlated. If you use a lasso type estimator with data that is correlated, the selection is not very reliable. So I think that deserves some more discussion here in this paper. The other part that I would suggest is related to the presentation of the results. I very much like that there are very general assumptions and that there are these many rate conditions that clarify on a very general level what matters. But it makes it also harder to read the paper. And if you want applied researchers to use your work, it might be useful to provide more intuition. One example would be to use two toy examples that highlight the two key features of your paper. One is the persistence, which you can model with some ARMA model, and the other one would be the heavy-tailed feature. And for these toy examples, show explicitly how your results would look like and do it throughout the paper. And I think it would also make sense to discuss empirically relevant cases for all the rate conditions that you have. Because for an applied researcher, it might be hard to understand what are cases when all these many rate conditions are actually satisfied in a relevant setup. Now let me come to the tuning parameters. I mean, as in any type of lasso paper, there are choice parameters like the amount of shrinkage that you use. And this tuning parameter can be selected by cross-validation, and that's what you're doing in your empirical and simulation setup. When you present this theory, you also impose assumptions on this tuning parameter lambda. And I'm just wondering why you're doing it, because my view is that the assumption should be on the population model and not on a tuning parameter that is chosen in a data-driven way. Another thing that I noticed was that when you estimate this bias correction and the HAC long-term variance, you need to estimate a lot of node-wise elements. So there will be a lot of node-wise lasso regressions. Each of those requires a lasso tuning parameter. So in the end, you have tons of tuning parameters in this paper. I'm just wondering if you would like to comment more on the robust simultaneous selection of all of these tuning parameters. When it comes to the simulation, you only consider the simplest possible toy example of an AR1 model that has a normal distribution, and all these AR1 covariates are independent. I would like to see examples where, first of all, the general theory that you develop is necessary, and examples that would also help us to understand better how your approach would perform in realistic data. So coming back to these toy examples that you can use throughout your paper, like an ARMA model, a heavy-tailed model, and I think on top of that, a model where you have more dependent covariates. I would like to see the simulation results for all of these three different setups. And then you can highlight how these different rate conditions that you have derived play a role here. Coming to the empirics, I would like to see measures of fit, in particular in an out-of-sample analysis. So far, I miss results where I can see how much better different versions of your estimators do. I would also like to see inference on an out-of-sample part of the data. That means you estimate your sparse set of covariates on the in-sample data, but you do the complete inferential analysis and confidence intervals out of sample, and that would be evidence that you're dealing with this post-selection issue. Last but not least, it would be nice if you could follow up on this dependency in the covariates, because again, lasso is not very well suited for dealing with highly dependent data. And I'm not sure if in your empirical example, it might not be the case. So let me wrap up here. So it's a nice paper with very general theoretical results, and I'm sure it will have an impact on other papers that can use these tools. So I view the main contribution, the Huang in bias correction, for time series that are non-Gaussian, have heavy tails, and are persistent. And I think it's a very interesting empirical study, and I recommend everyone to read it. So thanks a lot, and I look forward to your comments.
All right, thanks a lot for the very insightful discussion. And Andrea, would you like to respond?
Thank you very much, Marcus. So lots of interesting comments. Yes, it was a great discussion. Yes, on the issue of post-model selection. So to me, this post-model selection issue is just an issue of uniformity. And indeed, when we do bias correction, it is fairly easy to show that we have uniformity. So we didn't do that, but I guess we could try to do that. And also, I would like to emphasize that when we talk about Granger causality tests in terms of projections, so for the projection model, we may have serial correlation, and it is important to do Huang-based inference. And yes, thank you very much for all the references.
All right, so actually I have a quick question as well. So you managed to show that in the heavy tail case, you provide a new concentration inequalities, which is obviously very nice. And the rate is polynomial instead of exponential. But it's also interesting to see that this polynomial rate didn't hurt your convergence rate for the beta, which is still square root of t. So I wonder if you did place some restriction there to make that happen. And secondly, seems to me that possible we can consider Huber's estimator, Huber's loss function instead of the L2 loss, or some trimming technique to cut the data to cut those large heavy tails, right? So that you can achieve exponential rate again. You don't worry about the polynomial rate. So yeah, that would be my question.
Okay, thank you very much. Yes, excellent questions. Yes, so on the Huber loss, we know that it cannot handle heavy-tailed covariates. So it can get you robustness to heavy tails in the error term, but it doesn't handle the heavy-tailed covariance, because if you look at the score, so in the score we get covariates, and yes, it cannot do it. And what was the first question?
The first question is, this polynomial rate concentration inequality does not affect your convergence rate for the parameter, which is your square root t. Yeah.
Yes. So yes, it's an excellent question. So yes, to me, lasso is just an example. Inference for lasso is just an example of the semi-parametric inference problem. And with this debiasing or partially out, we kind of have some nuisance parameter. And so as long as this nuisance parameter has sufficiently fast convergence rate, we can get the the usual parametric rate for the low dimensional groups of coefficients. So it was kind of expected even in 80s in the semi-parametric literature. And we had this for non-parametric results, and yes, so this is the same intuition.
Right. So the polynomial rates are fast enough for you to get the downstream square root t rate for beta.
Yes.
All right. Thank you. So I think my job is done here, and we have a great session. Thanks all the participants. And now I'm going to give it to Eric to conclude the entire conference.
Thank you, Dasheng. First of all, to all the presenters on behalf of Dasheng, Brian and myself, thank you, and the discussants. I mean, we had I learned a lot during this conference. Thank you very much. Also, thank you for all the participants to having participated in this event. I'd like to finish perhaps with a few things about the Society for Financial Econometrics. First of all, every other Monday, there is a seminar series which is hosted by Andrew Patton from Duke University. And this Monday we have Seth Pruitt presenting a paper with a discussion by Jenny Bai, and that event is repeated every other week. Please visit the SOFI webpage to find more information about it. Really close to the topic of this entire conference, I'd like to highlight the fact that SOFI also organizes summer schools, and there are two that will take place this summer that are very closely related to the topic of this conference. One is by Olivier Scaillet and Fabio Toriani, who will be presenting high-dimensional asset pricing models. That's not exactly the title, but the details are on the SOFI webpage. That is the one that will take place in Brussels, but it will be a virtual conference. So please check out the details, as it will be online via Zoom. And also Jinjin Fan and Dasheng, she will be also presenting a summer school. This one will be organized out of NYU Shanghai. It is also on high dimensional data analysis in finance. And again, the details are on the SOFI webpage. Last but not least, I really would like to reiterate thank you to Chelsea Donahue for having helped us organize this event, Victor Quadros for doing all the IT support, and to our sponsors, the Keene Institute, the Journal of Financial Econometrics, SOFI, and also the International Center for Finance at Yale University. Thanks again. We hope that you will stay tuned to all the SOFI events, and it has been a great day. Again, on behalf of Dasheng, Brian, and myself, have a good weekend, and see you soon again.